Okay. So let's come to the issues one by one. So you'll be looking at the business valuation. Okay. So the business valuation, how we are going to be looking at valuation of equity and debt. Most of the time is between equity and debt. Okay. So how do we value equity? How do we value debt? Okay, that is what we are going to be looking at. So if you want to value equity, one way is to use the accounting equation. Okay, because we know that the accounting equation is total assets is equal to total liabilities plus what? Plus equity. So if you want to find equity, then you can make the equity the subject from that area. Or if you want to find the value of equity, you can also play with what? With some of the what? Some of the investment ratios. Okay. So that is how we are going to be looking at it. For debt, we just find the value of the debt from the what? The cost of the debt for perspective. So we know how to find cost of redeemable debt. So we just find the present value of all the cash flows arising from that, because the cost of the redeemable debt is that particular discount rate. If you use it to discount the cash flows, it will give you the what? The market value as of today. So the internal rate of return. So we use that one. The irredeemable, we play with the formula, the interest over the interest market price. Then we play with the formula and get that one. But mostly the focus is not about debt valuation. It's always about equity valuation. So how do we go about that one? We'll be looking at all the methods over there. So we'll be looking at the net asset method, the price earning ratio, and the dividend valuation what model. Okay. Then we come to the mergers and acquisition. A company would like to expand, and the expansion would be like, okay, let's go and merge with what? Another company like the Airtel Tigo. So the Airtel Tigo, they are putting what? Two companies together to be one entity. So that is a merger. Nobody is buying anyone. Okay. But you can also want to expand where you have to go and buy a company that is already operating. Okay. That is the acquisition that you do in the financial reporting. Okay. That is a form of acquisition. A company in Ghana, they want to expand their operations towards to Nigeria. They can go there and what? And acquire a company that is already operating in Nigeria. Or we can go there and do everything ourselves. We can go there, set up everything ourselves. What do we set up? We go and rent a place and we send our own machines there and our own workers over there. Okay, that is also a form of our expansion. But that one we are going to be financing everything ourselves. That is internal growth or organic growth. So we'll be looking at the mergers and acquisition, the calculations associated with it, the theoretical aspect of it, the benefits, the disadvantages, and all those things. We look at that one. Then we come to financial risk management. So the financial risk management, we are talking about what? The issues of what? Exchange rate, what? Differences. So a company in Ghana is selling to what? Customers in US. These two people are now going to be having different what? Currencies. Ghana, we use what? We use Ghana cedis. US, they use the USD, the dollar. Okay. So now, how would this particular issue be done? Are we going to be billing the person in USD and they will pay the USD to us, or we are going to be billing them in Ghana cedis and they will pay the USD to us and we exchange it? Okay. So if we are selling to the person now and the person is paying at a future date, it is likely that the exchange rate at today might be going in our favor in the future or at the time that the person is going to be settling, or at the time that will be going against us at the time that the person is going to be paying the amount. So how do we don't know the movement because you cannot predict it. You cannot have accurate prediction of the exchange rate movement. So how do we mitigate or how do we try to what? Reduce the impact of the exchange rate uh, movement. So that's what we call the financial risk management. So we'll be looking at, if we have time, we'll be looking at the issues of the currency risk that is going to be with the money. How do we manage them? And we also come to the interest rate what risks. If you want to invest, okay, today the interest rate is 10%. How sure are you that in 6 months time that you want to invest, the exchange rate will be increasing or be reducing? You don't know. So how do you try to what? How do you try to control the movement in the exchange rate? So we also do some arrangement to be able to what? To reduce the impact, the positive or the negative impact of the what of the movement in the exchange rate in the future. So that is what you are going to be doing under financial risk management. So this will be 15 marks. Okay, mergers and acquisitions is now 15 marks, and this will also 15 marks. So the financial risk management, most of the times the concentration is about what? It's about the theory aspect. So they will give you some calculations, but the theory aspect is going to be what? It's going to be, it will always come there. And the theory aspect, mostly it is the difference between a forward contract and what? And currency futures. And I've included that particular differences over there. So at least you should be able to keep 10 or you should be able to keep 5 in your head. Or they can also ask you about the what? About the hedging techniques, which can be internal or external. Okay. Then we now look at what? Time value of money. So the time value of money has now been what? Has now been added to investment appraisal for 20 marks. What it means is that you still see this thing like 10 marks or 5 or 8 marks, and the investment appraisal will take like 12 or 11 marks or 10 marks. Okay, so you time value of money will still come in the exams, although it's under investment appraisal, but they cannot give you investment appraisal question for 20 marks. No, the highest will be like 15, and the minimum will be like 10. So maybe they can give you 10, 10, 10 for investment appraisal, 10 for financial, 10 for the time value of money, or they can give you 12 for investment appraisal and 8 for this particular one. So whatever be the case, you still see a question on time value of money. So we have done this. We look at the issues of the compound interest. You have the issues of annuity. You have the issues of the loan. You have the issues of the sinking fund. Mostly it's going to be based on annuity, or it can be the combination of the compound interest and then the annuities. So you always have to be very careful if you are doing the time value of money question. It's very what? It's very for time value of money, you need to think deep before you can actually what make an attempt. Okay, you really have to think. All right. So we are going to be looking at 40 or at least 30 something marks question today, and we see what we can do. So the let's start with the issues of business valuation. Charles, are you there?
Hello, sir.
Yeah, Charles, are you there?
Yes, please.
I hope you are doing well.
Yes, sir. I am. I
Who,
hope you
who,
are too.
yes, please. Who is winning the listing?
So winning.
Are you not on campus?
NSMQ. Yes, yeah. So I
Oh,
actually don't. Huh.
okay.
I'm sure it's going to be in front of him.
Okay.
Charles, are you from UCC?
Yes, please.
Become accountant.
Yes, sir.
Okay, level 400.
Yes, sir.
Okay.
Do you want to
That's
ask whether he knows you or not?
yeah, maybe.
Then you are not popular. Which position were you had? Were you holding there?
I mean, I'm popular. Oh.
That's a, so many. Just let's
I'm
move on.
popular.
Let's look at it.
Okay. And please scroll up for me. Or the requirements.
Yeah, let's look at the requirements first.
Okay. So A, what is the cost of this transaction? Oh, sorry. That's question 2. A, calculate the growth in dividend. And B, determine the value per share of Camo Limited using the following methods. One is asset-based model, II, dividend valuation model, and III, price earning ratio.
Okay. So they're asking us to calculate what the growth in dividend,
Growth.
isn't it?
Yes, sir.
Okay. So you can see that looking at this one, we cannot find any issue about the. So if you look at the statement over here, you can see that you are going to be having dividend for all in this year, isn't it? Which
Yes,
is
sir.
2023. So it means that we have to read a footnote to know maybe certain issue about the dividends so that we can actually calculate the growth. So just can you 1, 2, 3, 4, 5, 6. That's 6.
Okay. So 6. The dividend have grown from Ghana cedis, from 50 million Ghana cedis in 2019 to 26.235 million Ghana cedis in 2023. And the growth rate is expected to remain the same even in the future.
Okay, so how do we calculate the growth? Is it going to be trend analysis or the Golden's growth model?
Right.
Okay, it's going to be trend analysis. Okay, what is our final dividend here?
26.235.
Okay, so that is, we are doing this for 2023. So that particular one, this is the dividend that we are talking about. So 26.235, you can see that they are picking, they are holding what, 3 zeros there. So they are changing into million now. Okay, and they are saying that the dividend have grown from what, 15 million in 2019 to what? So they have given you the initial dividend to be 15 million and the final dividend to be what? 26.235.
26.235.
Okay. Okay. So what you do is this one. So let's count to question number 1. Okay. So we know, okay, question number 1, which is the A, we are calculating the dividend growth. Okay, so we are calculating the dividend growth. We know that the growth is what? G is equal to final dividend or current dividend. Okay, over the initial dividend or the fixed dividends. Okay. Please don't go there and use the square roots. Okay, most sometimes I'm using that one. Most of the students, they are confused. So just stick to this one. If you can understand the roots, there's no problem. If you're using indices, square root is the same as the number in the what? In the root exponent half. Okay. Cubic root of 4 is the same as 4 exponent 1 over 3. So it's the same thing that we are doing over here. Okay. So let's come to our final dividend. So final dividend is now what? So let's put a final dividend. Let's bring all of them one by one. The final dividend is 26.235 million, isn't it?
Yes, sir.
Our initial dividend is now what? 15 million, isn't it? Okay, how do we find the N now? N, how do we find the N now? They say the growth is from 2019 to 2020 what?
Yes.
To 2023, isn't it? Okay. The first growth will be 2019 to 2020, isn't it?
Yes, sir.
Okay. And the second
That
one
will
will
be
be
4 years.
2020 to what?
2021,
Okay. 2021 to what?
2022,
Okay. And 2022 to what?
2023.
Okay. So the dividend has experienced what?
Four increases.
Okay. 4 times growth over the years. Okay. I will tell you the simplest one. Okay. You can just find the years over here. What is the years over here? This is going to be 5 years, isn't it?
Yes, sir.
So subtract 1 from it. Just find the years and subtract 1 because the 2019 itself is not going to be experiencing any growth. It will be 2019 to 2020. So just find this will be 5 years. Subtract 1 from it. That will give you the number of growth. But if you cannot do it, just do it the 111 that I've done. Okay. So the N over here will be 4. Okay, the N over there will be 4. So our G now is equal to 26. Okay, this will be all be minus 1. Sorry. I don't know why I
Yeah,
don't
right
want
on.
to be minus 1.
There is feedback from your background or from the
Okay, so we have 26.235 divided by 15 million exponent 1 over n minus 1. All of this multiplied by 100. Okay, what are you getting?
15%.
15. Okay. But you have to repeat at least. You can also repeat this one, but there's no problem. Three steps is okay, no problem. Okay, 3 steps is okay. So there's no problem with that. Okay. So we are done with the growth now. It's not anything. Okay. It's not anything. The next one is to determine the value per share of what? Camel
Common
Limited
using the
using
asset-based model.
okay. So the asset-based model is just like the net asset model. Okay. So we have this particular one using so we calculate the value asset-based model. So the asset-based model is just like how do we calculate the net asset, which is the equity. That will be asset, total assets minus what? Total liabilities. But in this case, we use what? We use current values. We use current values. We use current values. Okay, you use current values. You use market values, not book values, unless nothing has been given about that particular item and you use the word the book value. We are valuing the business. What is the current value of the business, not the book value? So what is the current value of the business? So we look at the current value of the asset. Okay, so we now have over here, I'll be showing you two, and you like the one that you pick the one that you want to use. Okay, nobody's going to penalize you. Okay, but let's try the two, the one you are comfortable with. Then you can actually pick that one. Okay, so Charles, let's pick the assets one by one now. What are the assets there?
First one is property, plant, and equipment.
Okay, so there might be some revaluation with that one. So you have your PP over here. The figure that you have over there is a book value. How much is it?
250,000.
Okay, so you have 250,000. You put it in brackets. Okay, there might be some issue that will be reducing. This is the carrying value. There might be issue that is going to be relating to the what? The market value. We use the market values. We use the what? The market values. Okay, the next one is what?
Motor vehicle.
Oh, how come the property plant there? Okay, motor vehicle is different. So motor vehicle.
120,000.
So we put that one too in brackets. Okay, 120.
Goodwill.
Goodwill, will it be part?
No, sir.
Okay, you ignore for now. Sometimes they can give you the market value. Okay, doing the business valuation, we don't include what? The intangible assets unless they have what? Market value. So we will leave a space for the goodwill now, or you can bring the goodwill and you make it 0. Okay, you have the value over there. How much is that?
30,000.
So the 30,000, if there's no information, you subtract 30,000 from it again. Then that will give you 0, no problem. So let's come to
Inventory.
we are putting all the assets together. So we have inventory. How much is the inventory?
50,000.
50,000. Okay.
Receivables.
Receivables,
30,000.
30,000.
Bank. 20,000.
90,000. Okay, let's come to liabilities now.
So we have the 10% debenture.
Okay. So liabilities now, we are just putting all these things together. If you want to separate it, no problem. So we have 10% debentures. Most of the liabilities, because they are always, the current value will still be the same as what their book value most of the times. Okay, this one is how much?
40,000.
40,000. Okay, the
And
next one is,
payables.
so we have payables
Payables.
to be
10,000.
10,000. So let's take the additional information now.
Okay. So additional information 1. The company has 10 million shares in issue.
Okay.
And 2. Property, plants, and equipment revalued to 300 million Ghana cedis.
So let's tackle that one now. What is the current value of the property, plant, and equipment?
250,000.
Okay, but what is the market value now?
300 million.
Okay, so what do we do?
We add 50 to the value there.
So we add 50,000 here to make it what? 300,000. Okay. Motor vehicle is now valued to what?
100 million.
But the value that we have in the books is what?
120.
So we reduce by
20.
okay, please. The reduction in the assets are treated like revaluation of the assets. So they don't affect what profit. Sometimes they will give you some items that you have to adjust the profit given to you. Okay. For the revaluation relating to assets, for the reduction in the value of the asset are treated as revaluation, which is other comprehensive income items. So they don't really affect what the the value of the profit. So we reduce this one by what? 20,000. And this will
20.
now give us 100,000, isn't it? Any information
Yes, sir.
about the goodwill?
Yes. They said the valuer failed to determine the market value of goodwill because it was internally generated.
Okay, even if you are not told, even if nothing has been said about the goodwill, you write the goodwill off. Okay, all intangible assets, unless they have market values. Okay, let's come to inventory. Any issue on the inventory there?
Yes, sir. They said among receivables, there is a client
That's
No.
who owed to the company.
Okay, that is receivables. So inventory, it means that the inventory can be realized at the current value, isn't it?
Yes, sir.
So this is the same as the 50,000. Okay, let's come to the issue of the receivables now.
Okay. So they said among receivables, there is a client who owed to the company 5 million Ghana cedis, declared bankrupt, and this will necessitate the revision of the drafted profit.
Okay, this is a bad debt, isn't it?
Yes, sir.
The bad debt is a profit or loss item, isn't it?
Yes, sir.
Okay, so this
Yes, sir.
we have to revise our profits now. The bad debt has not been written off. So since we are now coming to write off the bad debt, it means that the profit will be reducing. So that's why they say that this will necessitate the revision of the drafted profit. It's a profit or loss item. So it means that it's going to be reducing the profit that they have reported. That profit that they have reported is before taking all these issues into consideration. So it means that our receivables will be reducing by 5,000, isn't it?
Yes, sir.
So we come here and do minus 5,000. So that will give us 25,000. Please, the cash cannot be revalued. Are you okay? Then the only thing that will happen is that they will say, included in the receivables is an amount owing, and this amount has been received by the accountants, and the accountants maybe use the money for personal something. So maybe there can be some issue like that. That will also be affecting the receivables. So what is the total value of the asset?
495,000.
495,000. So our debentures will still be the same value, isn't it?
Yes, sir.
Okay. So you have your payables also to be 10,000, isn't it?
Yes, sir.
Our liabilities will be 50,000 now. Okay. So our net assets now.
445,000.
So let's make this one to be B. Okay. So you have the A minus B. That will give us what?
445,000.
So we have the 445,000. Okay. What are they asking us? Are they asking us to find the value of the entity or value per share?
The value per share.
So this
Using-
value over here is for the total number of shares over there, isn't it?
Yes, sir.
So value of a share will now be equal to what? The 445,000 divided by, what is the number of shares given to us in the question?
10 million shares.
Okay, sometimes they will not give you the number of shares. You have to calculate it yourself. So they will give you a certain information over here. If you count the share capital over here, so they can give you share capital at, then they will give you the value. So they can say at that at, then they will tell you that the at is now what? Is now they are issuing this at 40. So they will say at 40. At 40. Then it is at 40 means that at 40 Ghana cedis, a share is 40 Ghana cedis. So how many shares will give us the 400,000? You have to now divide to get your number of shares. So they can give you that particular one. But this one, they have given us the number of shares already. So the number of shares is now 10 million. So what we do is we divide our total number of the net assets. This is the total value of the what? Of the shareholders fund. And this is now 10 million. So we divide by 10,000. What are we getting?
44.5.
Okay. So we have 44.5 per what?
Per share.
Okay. Per share. Okay. I want to show you a different thing here. How can you also calculate this? Okay. Okay. So it is not for you to do plenty things. It's for you to work smart. Okay. What we are coming to do over here, and if what we are coming to do and what we have done, the two of you are going to be getting the same what? The same max allocation. Okay, if it is 4 marks, they will give you the 4 marks. Okay, so let's come here. What we can do over here is that we have to find our net asset. Let's find our net asset before the adjustment. What will be our net asset before the adjustment? What is our net asset before the revaluation of what? Of the items. What will be our book value of the net asset?
450,000.
That will be 450.
450.
Okay. So you come to your net assets, book value of the net assets. Then you come to your net assets here. You just say net assets at book value. Okay. Book value. That will give us 450, isn't it? Okay. Okay. So this is just like you are doing what you are doing net asset at acquisition. Okay. Let's now come here. They have given you some fair value adjustments. Okay. Let's come here now. They are saying that the property, plant, and equipment revalued to 300 million. Okay. But the property, plant, and equipment that we use in our calculation is 250, isn't it?
Yes, sir.
So now the property, plant, and equipment is increasing by what?
By
50,000.
50,000. That is a fair value adjustment, which is going to be increasing our net asset, the book value of our net asset, isn't it?
Yes, sir.
Okay. So you come here and have property, plant, and equipment. You should have used 300 million to calculate this, but you use only 250. So it means that this will increase by 50,000 now. We come to our motor vehicle. Okay. The motor vehicle has reduced by 20,000, isn't it?
Yes, sir.
But we included 120 over here. So it means that this particular figure is in excess. You have to come and subtract the 20,000 over here. Okay. So we come over here also. You can see that the goodwill is also included in the calculation of the 450, isn't it?
Yes, sir.
So now the goodwill will no longer be there. It means that we have to remove the goodwill portion from that one. That is what? 30,000. Okay. Let's come here too. You can see that the receivables that we used to calculate the 450 was what? 30,000. Now they say that receivable is reducing by 5,000. So it means that we should have used 25,000, but we used 30. We have to come and remove the what? The 5,000 from it. So you come here and do your 5,000. What are you having as the final figure?
445,000.
Okay. So that is your figure over there. Then you now divide it by what? The 10 million shares and get your value per share. Very simple. If you use this one, you are going to get the same marks like someone who is using this particular one. Okay. If it is 5 marks, they will give the two of you the 5 marks. All right. So what is it? Let's move on. Just what is the next? What is the next one? Mostly, it is the net asset that they are going to be giving you more information on that. The next one is the dividend valuation model, isn't it?
Yes, sir.
What do you think? Which method do you think we can use to find the value per share here? How do you think the dividend valuation model, or which are we going to be using the dividend yield, which will be the dividend per share over the market price, which is the cost of equity, or we are going to be which of the method do you think we can use to find the market value per share over here?
Dividend growth model.
The dividend growth model.
Okay, dividend
That's
growth model.
the cost of equity adjusted to have that formula.
Okay, so you are giving what? You can see you are giving cost of capital, isn't it?
Yes, sir.
And you have given dividend, they have even asked you to calculate dividend growth, isn't it?
Growth, yes, sir.
Okay, so you can use the dividend. You can also see the dividends in the question. So you can use the dividend growth model. Okay, so we use the dividend growth model to estimate this one. So we use the dividend growth model and we play with the dividend growth model. So we play with the formula for the cost of equity. We know that the cost of equity is the O over 1 plus the G divided by the market price per share, all plus the G. Okay, then multiply by 100. Now we are looking for PO. So if you readjust this, you'll be having your DO 1 plus G divided by KE minus G if you make your PO the subject. So they are asking us to find value per share. So we have to use dividend per share in our calculation. So let's calculate our DO now. We can calculate dividend per share, isn't it?
Yes, sir.
Okay. Our dividend given to us is
235.
Okay. Divided by the number of shares is 10,000. Is that correct?
Yes, sir.
What are you getting as the what?
Having 2.6235. 2.6235.
Okay. So let's check if the dividends are also in thousands. Okay, they are also in thousands. Profit or loss are also in thousands. So yeah, that is fine. So let's come to this place now and adjust our issues now. Okay, so we know that our PO will now be equal to 2.6235. 1 plus what? 0.15. Do you agree?
Yes, sir.
Yes.
Okay. Divided by 0.2 minus 0.15. Are you cool?
Yes, sir.
Yes.
Okay. We have PO. What is the top?
The top is
3.07.
5.012.
0.12.
0.17.
0.17.
Are you approximating?
No, sir.
Okay,
Okay.
No.
0.17, isn't it?
Right, sir.
Divided
Yeah.
by 0.05. Is the division 0.05?
Yes, sir.
Yes.
What are you getting?
Yes.
I'm having 60.34.
60.34
Yes.
per what?
Per share.
Okay. That is it for the dividend growth. Okay. If you want to use the dividend valuation, dividend we can use the what? We can use the dividend yield. Okay, dividend yield. They can give you the dividend yield of what? Of a similar entity. So what we do is that we adjust it, or we can also use the financials of the company itself. Okay. They also calculate their cost of equity. How was the cost of equity calculated? So we just play with the cost of equity formula using the dividend valuation model. Then we find it. Or they can also give you issues that you have to use to calculate cost of equity now. What they will do is they will give you information about what? About capping. So you first of all have to calculate the cost of equity before you can use the dividend valuation model. So you use the capping to calculate your cost of equity now. Then you now use it for the dividend valuation model. Okay. The next one is what?
The price earning ratio.
Okay, the price earning ratio. So the price earning ratio, what we do is that we play with it. Price earning is calculated as what? The market price per share divided by what? The earnings per share, isn't it?
Yes, sir.
Okay, we are now looking for the market price. So our market price per share will be equal to the price earning ratio multiplied by the earnings per share. Since the company is not listed, they cannot have what? They cannot have what? A price earning ratio, because we need market price to calculate the price earning ratio. But they can actually have earnings per share. Okay, because they will have earnings divided by the number of what? So the price earning ratio, if the company is not listed, we use the price earning ratio of a similar company that is listed, and we normally adjust it by 20%. We reduce it by 20%. But this one, the question is now giving you that you should reduce it to it should be reduced to what? There is something there like 2/3 or something. Just can you read the answer for us?
Hello?
Yeah, can you read that particular side?
Okay, so the appropriate price earning ratio of similar quoted companies is 12, but due to different risk profile, they have to be adjusted to 2/3.
So it means that we are going to be using 2/3 of the 12 to calculate it. Okay. A company that is not listed cannot be having the same share price as a company that is what? That is listed. Okay, so we always what? Adjust it by 20, reduce it by 20. Or you can, the answer that you have gotten, you can multiply by 75% or 80%. Okay. But this one they are saying that we should adjust it to 2/3. Okay. First of all, we are looking for a value per share. So we have to use earnings per share. Okay. But how do we calculate our earnings per share? This is how we do over here now. Okay. So let's compute the earnings per share for this entity now. So their earnings per share will be equal to, what is their profit after tax?
70,000.
Okay. The profit after tax is what? 70,000. Okay. 70,000 minus what? 5,000 bad debt divided by 10,000, which is the number of shares. I hope you agree with what?
Yeah.
Yes,
Yes,
please.
sir.
It's like they are giving tax rate. So once you
Okay, sorry.
bring
So we have to recalculate the profit. All right. So we have the profit before tax. Okay. I was thinking there's no tax rate there. So if there's no tax rate, we just subtract. So let's come to, let me just do adjusted what? Profits. Okay. So the adjusted profits. Okay, since the tax rate is given to you over there, it means that for anything, all the profit, you calculate that particular percentage on it. So you have to now calculate your new profit before tax and you apply the tax rate on it. So we start with the profit before tax. What is the profit before tax there?
100,000.
Okay, 100,000. And this 100,000 will now be reduced by the bad debt, isn't it?
Yes, sir.
Or 5,000. How much will be left?
95,000.
Okay, 95,000. So the 95,000 now will be the profit, adjusted profit before taxation. So we now come to the taxation now. The taxation will be 30% of,
95,000.
okay, what are we having?
28,500.
28,000.
500.
Okay. So what will be our profit after tax?
66,500.
66.
500.
Okay. Okay. But this one, if the taxation given to you, you are not giving any rate, you just subtract the 5,000 from the 70,000 and go. But this one, since they are giving us rate, it means that 30% on the profit. Bad debt will be allowed to be taken away from what? From the profit before we charge tax. So we now calculate our new profit before tax and now apply the tax rate on it. So we can now find our earnings per share here. So our earnings per share will now be 66,500 divided by what? 10,000 shares. So what are we having?
6.65.
6.65. So let's go here. So our market price per share will be 2/3 multiplied by 12 multiplied by 6.65. What are we having?
63.2.
Okay. So
Thank you.
market price per share will give us 6 multiplied by 6.65.
Say
So
8.
is it 8 or 6?
8, sir.
Okay, 4 multiplied. Okay, that will give us 8. So why is that particular issue there? So just what is the answer?
53.2.
53.2
Yes, sir. Cedis per share.
Okay. Okay. So what if they ask you to advise the price range for the acquisition? What are you going to be saying? They say advice on how much they should pay for what? For the shares. Okay, how much they should pay for a share. What are you going to be telling them? What would be the range that you are going to be suggesting to them?
Okay. So I'll say that the lowest range they could offer, they could value this company should be 44.5, and the highest they can accept as the value of this company is 60.34.
Okay. So the price range should be between what? 44.5 to what? 60 point what? 0.34. Okay, so that should be the price range. That should be the range that they should be offering for these individuals. Okay, so all right, just see.
Okay. So C, where there is hostile takeover bid received from another company, what are 4 defense tactics companies can use to avoid that unwelcome takeover?
Okay, so what they are saying, just what are they saying over here?
Some defensive tactics against takeovers.
So what are them? What are the defensive tactics that can be used to avoid takeover? So we have the defensive tactics against takeover. Okay, one is what?
So
Hello.
we have the poison pill.
We have the poison pill. Okay, what is the meaning of the poison pill?
So that's trying to make the company look unattractive by selling productive assets. Or yes.
Okay, so they will dispose of the what? The productive assets, and they'll make the, because why would the people be willing to do the takeover or to acquire the company? It's because of maybe the company is having the particular assets and they are interested in the assets, so they want to acquire the company. So they would like to, okay, they will now dispose of what? They will now dispose of those assets, and since you are interested in the asset and the asset is no longer there, you will be discouraged to what? To buy the company again. Okay, Charles, what again?
Have the white knight.
What is the meaning?
So we try to look for a particular person to offer a bid for majority of the shares of the company.
Okay, okay, okay. What again?
Then the white squirrel.
Okay. What is the meaning?
So this one, we look for someone to offer a bid, but we look for a person who the person trying to acquire or trying to make the hostile takeover is not in good terms with. So make it unattractive for him to be partners with that person.
Okay. Okay. What again?
There's also the golden parachute.
Which one? Okay. So you have the
Okay.
golden parachute. Okay.
And with the golden
Yeah, you can talk.
Okay. And with the golden parachutes, that's where the managers of the firm try to demand high severance pay so that the people trying to take over would be feeling reluctant.
Okay. Okay. What again?
Okay.
Reverse takeover.
Okay.
Reverse what? Okay.
A reverse
Take-
takeover.
Okay. What is the meaning?
Where the target makes a takeover bid to the predator company.
Okay. 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 What again?
Also, management to convince shareholders that the offer is cheap and not favorable.
Okay. All right. I hope the 6 is okay. They were asking for only 4, isn't it?
Yes, sir.
Okay.
Yes, sir.
Let's go to the D.
Okay, so D. Briefly discuss 4 key considerations in performing financial due diligence in making investment decisions like mergers and acquisitions.
Okay. So what are you going to be considering? If you want to briefly discuss 4 key considerations in performing financial due diligence in making investment decisions like mergers and acquisitions. Due diligence is that you want to do like what do you want to do? You want to do a background check on whatever you are coming to do to see whether what you are going to be doing is what is going to be profitable, is going to be legit, or whatever you want to do, whatever decision that you want to undertake is going to be legit. Okay. So they are saying that the consideration that what are the things that you should be taking into consideration when you want to make decisions? Okay, decisions like mergers and acquisition. Okay, just what are some of the things that you are going to be taking into consideration when you want to do something like background check in regards to what mergers and acquisition?
Their current capital structure.
Okay, so you can talk about the capital structure. Why will you look at the capital structure of the entity?
Okay, so if this entity is highly geared, there is that high probability that it might go bankrupt very soon. So acquiring this is not going to be a very good investment decision for us.
Okay, okay, that's not bad. What again?
Its market share.
Okay, so market share is not bad. Why will you be considering the market share?
Because if this company we are trying to acquire has a smaller market share, it's going to be very difficult for us to try to earn a lot from this company. And it's investments we are trying to make. So we are looking at the highest potential benefits we can get from an investment.
Okay, okay, okay. What again?
We could look at the
Please, the question is not for Charles alone. The question is not for Charles alone. So
That we also check in the comment section.
okay, okay, okay. 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 The gearing level is a capital structure. Charles has spoken about that one already. Okay. The financial position of the company. Financial position of the company. That's not bad. So we can look about issues of liquidity. Okay.
Hello, sir.
Yes, please.
Can we talk about reputation or goodwill?
The reputation is also not bad. Okay. So a company that is engaging in illegal money, if you are going to acquire them, that will have a bad a bad effect on the what? So the financial projections, tax implications. So there are financial projections. Okay. So we can also look at the tax benefits. So we have the tax implications, the tax benefits that we are going to be getting. So if you acquire certain companies, they will be giving you a higher tax benefit. So we can also look at the tax implications. Okay. So we
Excuse
have,
me, sir.
yes, please.
Considering the reputation our friend just gave, even though we are being asked for financial due diligence, can we still mention the reputation
The question is about financial
due diligence?
in performing financial due diligence. The reputation is the reputation in one way or the other affects the financial issues. So if
Okay,
a
sir.
company with a good name, it is going to be what? It is going to be increasing your profit in one way or the other. Are you okay?
All right, sir. Thank you.
Okay. All right. So you also look at someone is the tax implications, the financial projections. That is also okay. You can also look at the what? Their assets. Okay. You can also look at their assets. The assets, what is the nature or what is the value of their assets? So sometimes the assets can be very old, and these people they are going to be overvaluing the assets. So you can also look at the asset to see whether they have the required asset to sustain their operations. You can also look at the issues of hidden liabilities. There can be hidden or undisclosed liabilities. There can be some undisclosed liabilities that after you have acquired them now, then they will be what? The people will not be coming after you. But this liability has not been disclosed in the financial statement of the entity. So you also have to look for the issue of what this liability. Is there any liabilities that are not being disclosed? Is there any liability that has not been disclosed? Is there any liability
Yeah.
that has not been disclosed by the entity? Yes, please.
Can you say the location of the entity?
They are all parts of the reputation. Okay, we are all talking about it. So let me just say intangibles here. Okay. So let me just talk about their intangible assets. So we also consider their intangible assets. So all those ones will be part of the intangible. So I hope you're okay now.
Yeah.
Okay. So yes, these are a few of them. So that is not, I'm not sure you have to, yeah, that is it. That is it. Okay, let me check now. Someone said I should check the comments. Let me check. Let's see what we have here. So financial performance, the financial position, general level, weekly level. Please, why did we use 2/3? Charles, why did we use the 2/3?
Because of the adjustments the question told us to make.
Okay. Bernard, you said you have a question.
Yes, sir. Please. I wanted to ask. You see, this question asks us for asset-based model, but in some question you can see the question will go like strictly. First one, use net book value. Second one, replacement method. Third one, net realizable value. So when you are doing the net book value in that case, no, do you have to consider the revalue, the revalue to revalue to?
Are you setting your own question, or you're answering the question that the examiner is asking you for the net book value? if you are using revalued amount now, are you setting your own question or you are answering the question that they're asking to use book value?
We are answering.
Yeah, you use the book value. The question says use book value, so you have to use book value. So use the carrying values.
Thank you.
Okay. Then the question will give you replacement cost. You have to use the replacement cost to value. The question will say they will give you the net valuable value, but they will give you the cost, the fair value less cost to sell. So you have to find the net valuable value for each of them and use it. But whenever you are being asked to use either balance sheet valuation model or the net asset model, you use the market values. Okay, unless the question is asking you to use book values or whatever. But if you are being asked to use book values, you use the book values. If you are being asked to use replacement cost, use replacement cost. If you are being asked to use going concern or breakout values, you use the breakout values. So now I hope you're okay now.
Thank you.
Okay, just can we make a move now?
Okay.
Okay.
Hello, sir.
Yes, please.
Sir, please, can I see the workings for the P ratio again? I think I didn't capture something.
No, please, you can't.
Okay.
I say no, please. So any follow-up? Okay, it is
Sir,
your right. It is your right to tell me you want to see. But if you're asking me, can you see? You are giving me options, which I have the right to choose. Okay, so I want to see, not even so, Linus, I want to see the whiteboard. Okay, I will go there for you. It's your right. Okay.
thank you.
But if you are giving me, can you, I have the choice to say, I'm an African, so I have the choice to say no. You say P ratio, isn't it?
Yes, please.
So this place. So the question is asking us to reduce the price earning ratio to what? 2/3. We should reduce it to a 2/3 because the company over here is a listed company. So we don't use the same thing. A company that is listed and a company that is not listed, they cannot have the same market values. So the one that is listed will be having a higher market value. So we reduce the one given to us. And the question is asking us to reduce it to 2/3. So that is why we are multiplying by the 2/3. Okay, should I move on to the next page for you?
Sir, please, the 12, where from the 12?
It's in the question.
Okay,
Okay,
thank
the 12 is in the question.
Hello, sir.
Yes, ma'am.
Sir, please, you made mention of that they could give you the dividend yield so that you adjust it like how we're adjusting the P. So I wanted to ask that with the dividend yield, will you adjust it like by reducing just like the P ratio or in a different way?
What do you think? What do you think you have to do?
So I think you adjust down.
Is that the NS that I know or is a different NS?
A different one, sir.
The dividend yield.
And is it the NS? I know one NS. Is it this one or Charles?
Sir, that's not him.
Okay. Okay, these are different NS. Okay. If you come to the dividend yield is the return that you are going to be paying. A company that is listed and a company that is not listed. Which of these two companies are the shareholders will be demanding a higher yield?
The company that
The one that is listed.
No.
Hmm.
A company
Not
that is
listed.
listed and a company that is not listed. Which of these two companies that the shareholders will be demanding for a higher yield on their return?
The unlisted one.
Yes, the listed one, the shareholders can actually sell the shares at any time. If the company is not doing well, they can sell it at any time. So they have the right to sell the shares at any time. So even if you are not giving them a dividend, they can actually sell their shares and get their gain and go. But a company that is not listed, I cannot easily sell my shares. So you have to now compensate me for what? For that particular risk of not selling my shares. So the company that is not listed will be having a higher yield than the company that is listed. So what you do is you adjust it upwards. So you increase it. So maybe you increase by 20% by now having 1.2 multiplied by the yield before you divide.
Okay, thank you, sir.
Okay, all right. So I hope we are fine now and we can move on. Just let's go now.
Okay.
Let's do something on the mergers and acquisition. Yeah.
Okay, so question number 2. Company XX intends to buy company YY. Double X has a market value of 200 million Ghana cedis, while double Y has a market value of 100 million Ghana cedis. Double X believes that if it buys double Y, the resultant firm will be able to save marketing and overhead cost by 20 million Ghana cedis every year forever. Double X pays 105 million Ghana cedis cash for double Y, and opportunity cost of capital is 20% required. A. What is the cost of this transaction? B. What is the gain from this transaction? C. What is the net present value of this transaction to shareholders of double X? And D. What is the gain to shareholders of double Y? And E. Supposing double X buys double Y by issuing 10,000 of its own shares to shareholders of double Y instead. If double X had 20,000 shares issued prior to this transaction, compute the cost of this transaction if the post-announcement share price of double X is 10,800 Ghana cedis.
Okay. Okay. So yeah, this is mergers and acquisition, but they can give you this question, but they will write plenty English for you, and they'll come and put this one somewhere. Okay. So this one is mergers and acquisition. Okay, a very simple one. A company will be buying another company, and for this one, this is just like purchase consideration. Okay, they can decide to pay by cash, they can decide to issue equity instruments, they can decide to issue preference share, they can decide to what pay with what land or property, any of them. Okay, but mostly it will be cash or equity. Okay, now let's come here. Which company? Who is the acquirer here?
Double X.
Okay, and they are buying Y, isn't it?
Yes, sir.
Okay, what is the value of Y? What is the value of the double Y? What is the value of the
Currently,
company?
100 million.
That is 100 million, isn't it?
Yes, sir.
Okay, but how much is double X paying for acquiring what? Y?
You said 105 million.
So how much, what is we call something, you see the cost of the transaction? The cost of the transaction is just like a goodwill to the acquirer. Okay. They're supposed to pay, all things being equal, they're supposed to pay 100 million, but they are paying 105, isn't it?
Yes, sir.
How much are they paying in excess?
That'll be 5 million.
So the 5 million is the cost of the transaction to what? To the one buying. So that is the cost of the transaction. It's just like a goodwill and a business combination. Okay. So the cost of the transaction over there. So we come to question number 2. So we have A, the cost is calculated as the cash or the proceeds or the consideration. So someone can say the consideration minus the market value of the company that you are buying, or the net present value of the company that you are buying, which is the YY here. Okay, so we are paying 105 million for the value of what? 100 million. Okay, so we are giving 105 million for 100 million. We are giving them 5 million in excess. This 5 million is what we call the cost of the transaction. In other words, it's just like a goodwill and a business combination. So that's what we call the cost of the what? Of the transaction. The next one is to find a gain on the transaction, isn't it?
Yes, sir.
Okay. The gain over here is just that after everything, what would be the benefit as a result of this particular acquisition? If the two companies are now combining, what is the benefit as a result of the combination? They have given us something like that over there. They are saying that if this thing happen right now, the entity will do what? The resultant firm will be able to what?
Be able to save marketing and overhead costs by 20 million every year forever.
So that is a benefit, isn't it?
Yes, sir.
So if the two companies are now combined together, overhead and what and overhead and marketing costs will now reduce by 20 million. If they are not combining, the two will still be incurring overhead costs that will be 20 million. Now you are not combining, so it means that that amount that you are going to be paying for overhead will no longer be paid. That is a cost savings. That is a benefit. This benefit is always calculated in present terms because we want to know what is the today's value. It is today that we are what? We are doing the business combination. So what is the today's value of the benefit? So this is annuity. I say annuity, this is perpetuity. Every year forever. So this is perpetuity. So we just find the present value of the benefits. The gain will always be the benefit that will be arising from from the acquisition. If the two companies are now joined together, what will be the benefit? The benefit is just a gain. The benefit is just a gain. So we come here, the gain on this transaction will be the cash flow over the discount factor, because this is annuity. This is perpetuity rather, not annuity. It is forever, forever, forever. Okay. So what we do over here is we have our gain over here. That will give us 20 million divided by what is the discount factor there, the opportunity cost?
20%.
Okay. So what are we getting?
100 million.
Okay. So we get 100 million. So the gain is 100 million. Okay. The gain is 100 million. But the question is, out of this gain, how much will be for the shareholders of what? The shareholders of double Y, and how much will be for the shareholders of what? Of double X. The question can ask you about that one. Okay. What is the net present value of this transaction to the shareholders of what? Of XX. Okay. They are just talking about a gain to what? To the shareholders of double XX. That is the net present value. So the C over here, the net present value of this particular transaction to these people, the net present value is this one. Okay. You can see that they are paying how much in excess to get 100 million.
5 million excess.
So what will be the net amount that will be left? What will be the net present value? What will be the net amount that will be left from the gain now? You can see that they are paying 105. Okay. They are paying 105 for 100 and 100. Do you agree? If
Yes,
they pay
sir.
105, they will receive all the assets of that particular entity. That is worth what? That is worth what? 100 million. And they will be having a gain also of 100 million. So it means that they are paying 105 for what? For 200 million. So what will be the net gain? What is the net gain from this particular transaction? This one is always calculated as the gain minus the cost, which is the same as the 200 minus the 105. Okay. So you can see that they are paying 5 million in excess. The additional cost that they have to incur is 5 million. They are incurring this 5 million to get a gain. So what is the net present value? What is the net gain? So that's the net gain will be the 100 million minus the excess amount, which is the cost, and that will give us the 95 million. So that is the net gain. That is the net gain or the net present value to the shareholders of what? The XX. Okay. Let's come back to what again? Okay, Charles, let's see here.
They are saying that supposing double X buy
No, the
double
D.
Y.
We haven't done a D yet.
Oh, okay. The gain to shareholders of double Y.
So what is the gain to them?
The gain is the excess cost we have to pay for their business.
And how much is that?
5 million.
Okay, their gain is the 5 million. Okay, their gain is the 5 million. So the gain to double Y will be 105 that they are receiving for what they are selling. That is 100 million. So that will give us 5 million. Okay. So they are selling something that costs 100 million for 105. They are getting a gain of 5 million on that. Okay, just let's move on.
So they are saying that supposing X buys Y by issuing 10,000 of its own shares to the people of Y instead. And if X had 20,000 shares issued prior to this transaction, we should compute the cost of this transaction if the post-announcement share price of double X is 10,800 Ghana cedis.
Okay, so they are saying that they are issuing what? 10,000 shares, isn't it?
Yes, sir.
Okay, so the 10,000 shares they are issuing now, we have to know the what? Because we are not looking for the shares that they are issuing. We are looking for the value that they are paying. So you have to calculate the value of the shares that will be given to them now. Okay, they say that the shares will be valued at what?
At 10,800 Ghana cedis.
Okay, and they are issuing 10,000 shares, isn't it?
Yes, sir.
Okay, so what would be the value that they will be paying to them in terms of shares? Okay, so what would be the value issued to them in terms of what? Shares. Okay, so what would be the value in terms of the shares? So we have the value of the equity that will give us 10,000 multiplied by 10,800. What are we having?
108 million.
Why what?
8
million.
108 million. Okay, so let's come here to the cost. They are asking for cost, isn't it?
Yes, sir.
So what will be the cost if they are giving them equity than what? Than cash.
In cash. So that's 8 million.
Okay, so they will be paying the 108 for what? 100 million. And that will give us 8 million. Okay, that will give us 8 million. So the cost of the transaction, if they are using equity, will be what? Will be 8 million. Sometimes the question can ask you to find the combined value of the what? The combined value of the what? Of the entity. Or they can tell you that the entity want to issue 50% of equity shares or 50% of the combined value of the company using equity shares. So how do we find a combined value of the what? Of this one? The combined value is calculated like this. Okay, so the combined value. So let me use combined value is calculated as the gain plus the market value of the two companies. So the value of the two companies or the sum of the value of the two companies. So I'll just say XX plus what? YY. Okay, so it's the gain plus that particular one. Okay. In other words, we are just looking at the gain. Okay. So sometimes they can give you the combined value. The question can give you a combined value to be 202. They are saying that if you combine the two companies now, the value will be 202, but they will give you the respective value of the two entities. They can give you 120 and they can give you 70. All things being equal, if you combine these two firms now, it's supposed to be 190. All things being equal, the value is supposed to be 190 because you are just putting the asset together. But they are now telling you that the combined value is 208. So the gain over here will be the 208 minus 190. So this will give you the gain. Okay, now we are using the same formula to find the combined value. That's why we are adding the value of the two firms, their individual values plus the gain. Same thing that we are doing over here. Okay, so they can actually tell you that 30% or 50% of the combined value to be issued in equity. So you have to find a combined value before you find a portion that will be issued in equity now. So what you do is that calculate the gain. The gain is just the benefit that will be coming in or the cost savings that will be coming in as a result of what? Of the combining the two firms. Then you add it to their individual values. So the gain plus the individual values will give us what? Will give us the combined value. Then you find the 50% of it. That 50% is what the acquirer will be paying using what? Equity. Then you combine with the value of that particular entity and see whether there is a gain or they are paying more or they are paying less. Okay, that is the cost to that particular situation. Just question number 3.
So question number 3. Companies may decide to increase.
Yes, please.
If you can go over the what we just saw under the mergers and acquisition, it was raining here, so some of the explanations I didn't get it well, especially at the aspect of the NPV of XX company, and then the gain, the one we had 100 million.
Which numbers? Which the can you point to the number?
I think question 2, B and then C. Where we B, where we use perpetuity formula to find the gain and then the NPV of XX.
Where we use the perpetuity formula.
Yes, to find the gain.
Okay, the gain, we say that the gain is the benefit, isn't it? And this is 20 million every year. And the opportunity cost of capital is 20%. So we use 20% to find present value of the annuity. That is the present value that we are finding. So cash flow over the discount factor, 20 million over 0.2. That is the gain. That is the benefit, the present value of the benefit that they are going to be getting from the acquisition. Okay, that is the gain. I hope that is correct.
Yes, sir.
Okay, we come to what is the net present value of this transaction to the shareholders of XX. So the net present value is just the what? The return after taking all the costs from it. Okay, this particular one, the entity is paying 105. The entity is paying 105 based on cash. They are paying 105. This 105, they are taking the value of Y. So they are taking the value of Y, which is 100. Okay, in addition to that, they are also getting a gain today, which is 100. So in all, they are getting a total gain of 200. In all, they are getting a total gain of 200, and they are paying 105. So what is the net present value? This is the cash flows. This is the net present value of the cash inflows. And this is the what? The net present value of the cash outflow. So you net it and you get your 95. Okay. Another way of doing this is that they are now having a gain of what? A gain of 100. Okay. The value of the entity that we are acquiring is 100. We are paying 105. So you can see that we are incurring additional cost of 5. This particular additional cost of 5 now will be net against whatever gain that we are receiving from what? From the acquisition. So we are paying 5 million in excess and we are receiving 100. So what is the net amount that we are receiving, which we call the net gain? It means that the 100 that we are receiving as a gain, the 5 million will now be reducing it because we are spending 5 million in excess, and that will give us 95. So any of them is okay. How that is fine now?
Yes, I think with the gain, I think the formula I know was 1 over the rate times the cash flow. So when I saw this one, but when I punched it on the calculator, I got it now.
Oh, senior, you power. 1 over
I'm
1
okay.
over R multiplied by the cash flow. It's the same as cash flow over R.
Yeah. Okay.
And that is it.
I'm okay.
Okay. Thank you. So, Charles, can we move on?
Okay. Question number 3.
Yeah.
Companies may decide to increase the scale of their operations through a strategy of internal organic growth by investing money to purchase or create assets and product lines internally. Alternatively, companies may decide to grow by buying other companies in the market, thus acquiring ready-made tangible and intangible assets and product lines. Require A. Enumerate 3 advantages of expansion through acquisition over organic expansion. And B. State 2 reasons mergers and acquisitions may fail to achieve the expected outcomes.
Okay. So, what are the advantages of mergers and acquisition over organic growth? The organic growth is just the internal expansion. So if you are buying ready-made assets and intangible assets, what will be the benefit that you are going to be getting done? You creating those things yourself.
Access to immediate market, international market.
Okay. So you haven't. So let me access to. So someone is saying cost synergies, acquisition of intangibles. Okay. Access to ready-made markets. Okay. Growth rate is fast. Okay. What again?
Question C.
It is very cheap in most cases.
Okay. It is. I think I like the way you are adding the in most cases. Okay. That is. You can't just go there and say it's very cheap. No. Some of the acquisitions are more expensive than what than doing some things yourself. Sometimes we pay the acquisition premium and all those things for that. So growth rate is fast. Okay. It is less expensive in most cases. That is fine. What again? Okay. It's a way of acquiring a competitor. So it's a way of avoiding the acquisition to be done by what? Than a competitor. So it's also a way of what? A way of boosting your what? Your strategies. Or you can also get competitive advantage if that particular entity so is also expert in or is also very active in its field of what? Of business. So they always say that two good hairs are better than one. Please pay attention. Two good hairs, not just hairs. Okay, two good hairs are better than one. So what Ethel will be doing alone, Ethel Tigo, they can do more than what? More than that. So it's also a way of building competitive what? Advantage. Okay. So that I hope if they ask you something, you can be able to say something with that. Just the second one.
So second one is the reasons mergers and acquisitions may fail to achieve the expected outcome.
Okay. So what are the reasons?
So we could
Difficult,
have okay.
difficult integration.
Okay. So the integration problems is one of the words. Is one of the integration. The integration is one of the problems. So sometimes you see these two organizations are going to be using different what organizational structure. Okay, they are going to be having different organizational structure, and their culture, their organizational culture is also different. So now trying to make these people now do things like the way you have been doing things is going to be taking what is going to be taking time and going to be having problems. So integration problems is also a problem there. Okay, integration. Okay, we have the issues of the integrations there. Okay,
Hello,
someone.
sir.
Yes, please.
Exposure to financial and then business risk.
Okay, the exposure to, okay, this, they are just talking about disadvantages, but you have to be very careful in how you present what? Present, uh, present your answer. So instead of saying the exposure to financial risks, you can say higher exposure to business and what? And financial risks. Okay, the financial risk can actually be, what if the entity can actually mitigate? What if the entity can actually what? Control the risk? So if you want to make it to be very attractive, higher exposure to what? To business and financial risks. Okay, so the entity, the exposure is too much and there's nothing that they can do to actually control that particular situation. Okay, so someone is saying valuation problems, lack of competencies in carrying out the new firms. Okay, no, those are all the things that you are saying. It means that when they throw a question at you, you can actually do something about those ones. Okay,
Sir,
yes, please.
can you say that the expected synergies are not received sometimes?
The expected what?
Synergies
Are not what?
are not received, like the gain they were expecting for the combination.
Yeah, you can, it means that your vim is, I don't know how I'm going to, okay, how do you put it? The vim is too high, but the reality has actually what? Has actually made you think that, no, this, so the higher expectations of what? Higher expectations of maybe some cost benefit or some benefit from the exposure. Okay, that can also be a problem. So the way they are presenting the thing to us, it looks what? Profitable. Especially those people that have been doing the marketing things. If they present a product to you, you feel like now even you haven't taken the product bet, you are okay. But if you actually take the product, you know that no, this is what the years use what we call aggressive marketing strategy to kill your bean. Okay, so that can also be a problem. So that can also be one of the problems. Are you okay? Or one of the reasons. All right. So let's come to issues with financial risk management. Just try for us. Let's see.
Question number 1.
No.
Okay. Financial risk management. Question number 1. We have Ulster Co., a UK company, is in the process of negotiating an order worth $1.4 million with a large US retailer on 6 months credit. If successful, this will be the first time that Ulster has sold goods into the high competitive US market. The company's treasury department has provided the following. So the current spot rate is $1.8960 to $1.8970 is equal to £1 pound. The 6-month forward rate is $1.8840 to $1.8860 is equal to £1. And we have annual borrowing rates and annual deposit rates both in UK and in USA. So required. A. Working to the nearest £1,000, how much would Ulster receive in pounds in 6 months if they use a money market hedge? B. Calculate to the nearest pounds the sterling receipts for Ulster if they invoiced in dollars and used a forward exchange contract. And C. If the exchange rate were to move to 1.8870 to 1.8900 equal to £1 in 6 months' time, what would be the exchange gain or loss compared to today if the company did not hedge the transaction?
Okay. All right. So okay. So mostly your calculations will be about money markets, forward contracts, and currency options. Okay. The rest will be a theory issue there. And let's see what will. Okay, so let's see what will happen over here. And we see. Okay, so the first one, this is a receipt, isn't it?
Yes, sir.
So this is a receipt, and they are going to be using money market. Okay, so just how do they go about this one? How would they be able to hedge this particular one using money market?
Okay, so in the money market, when we are dealing with the issue of receipts, over here, we know that we are going to receive an amount of money at a time in the future. So we actually borrow that amount of money now, but we borrow the present value of that foreign amount we are going to receive in the future now, convert it into our currency, and then invest it to attract an interest rate or a deposit rate. Then at the time that the money is ready for us to receive from our debtors, we just give that same money to the bank, and the bank just gives us what we deposited with our interest on it.
Okay, that is it. Thank you. It means that if you see question on the money market, you don't have a problem there. So this is one we use borrowing and lending to do this particular issue. Okay, you are receiving 1.4 million in 6 months' time. Okay, you don't know you don't know how the exchange rate will be moving. You don't know how the exchange rate will be moving. You don't know. You don't know how the exchange rate will be moving. So what you have to do is that you want to enter into agreement with the bank. You go to the bank and say, okay, I'm receiving this amount of money from these people in 6 months' time. Okay, I want to sell this amount to you now. What it means that we want to borrow. Okay, I want to sell it to you now. Okay, what the bank will do is that the bank will borrow this amount at their borrowing rate. So it's just like you are receiving money from somebody in 6 months' time, and you want the money now. If you want the money now, the person will not give you the same amount that you are going to be receiving in 6 months' time. No, The person will just give you a certain amount now. If the person charge interest on that particular amount, it will give you the total amount that you'll be receiving in the future time. So the person will give you the present value of the amount using the person's borrowing rate. So the bank will give you the present value of that amount because the bank is now lending you this particular amount of money. So they will give you the amount at their borrowing rate so that in a 6-month time, you receive the 1.4 and bring it to the bank. So you go to the bank and borrow the present value of this amount. Then you quickly sell it to the bank. Selling it to the bank is that you are going to be converting it to your local currency now. Because you are here to bring the 1.4, you will ask the bank to put that particular one on deposit for you. So that if you bring the 1.4 in 6 months time, the bank will also pay you that particular amount. So it means that you are going to the bank to sell the amount to them today. How do you sell that amount? The bank will borrow you first before you sell it to them. So if you sell it to them, the bank will now put it on deposit for you for 6 months because the bank will not give you the amount today. You have to bring your amount before they can also give you their own. So what we do is that we come for receipts. If you want to match, you first of all go to the bank to borrow. How do you borrow? The bank will give you the present value of the amount that you are receiving because they cannot give you the 1.4, which you are going to be receiving in 6 months time. No. They will give you the present value of that. So what is the present value of this amount that the bank's supposed to give you today? We find that by just finding the present value of this amount. It's a very simple exercise over there. So we find the present value of this particular 1.4. So let me come to financial risk management. Financial risk management. So financial risk management. So we look at the present value of the receipt. So that is the amount that the bank will borrow you. So the present value of the receipt. How do we find present value? Is the future value divided by what? 1 plus R exponent n. How that is correct?
Yes, sir.
Okay. So let's come here. They're asking us to do this one to the nearest 1,000, isn't it?
Yes, sir.
Okay. So what will happen over here is that we have 1.4 million. The 1.4 million will give us this figure. This is in USD, isn't it?
Yes, sir.
Okay. So 1.4 million. Okay. What is the borrowing rate in USD?
Yeah, is it present value or net present value? Because you are rating NPV.
It should be present value. Okay. It should be present value. So we have the present value. Okay. So what is the borrowing rate?
8%.
So borrowing rate is 8%. But that is our annual rate, isn't it?
Yes, sir.
So that will be 1 plus 0.08 divided by 2, isn't it?
Yes, sir.
Exponent what? 1. This will be only 6 months. So we are doing this for 6 months. What are you having?
One 1,346,153.85.
So we have the present value to be 13
153.85.
1346
153.85.
Okay. Can we have something like that?
Yes, sir.
Okay,
Yes,
let's
sir.
say to the nearest 1,000. So let's come here. 6,154. And which of them is it closer to? Is it closer to 7,000 or is closer to 6,000? Or let's do all the work and
It's
now
closer
change.
to
Let's change the final answer. Okay, let's do everything and change the final answer. So this will give us what? 153 point what?
85.
Okay, so let's do everything and now change it. So if you go to the bank right now, this is the amount that is supposed to give you today. Okay, they are giving this amount because you don't have the money now, so they are borrowing this amount. So this is the dollar equivalent that they'll give to you, so that in the 4 years time, this amount will now accumulate interest at 8%. In the 6 month time, it will now accumulate interest for 6 months, and that will now give you the 1.4 million. Then you bring it to the bank. But what you do over here is that since you are not bringing the 1.4 million, the bank will not give you this amount. But you want to avoid holding the money in USD. So you now tell the bank that, okay, if you change this amount to pounds now, how much are you going to be giving me? So you ask the bank to change this one. So you now sell this amount to the bank. But since you are here to bring the money, you tell the bank that they should put this one, they should keep this one for you for 6 months. If you bring the dollar, you count for the pounds. So you now convert this one to the pounds equivalent. So we do this one to the pounds equivalent as at the time that we are doing this. We are doing this now. Okay, so we always use the spot rate. We are doing this now. You can see that we are doing this now. So 6 months is a 1.4, but the value that you are receiving is now. So this is today. So we use the spot rate. Okay, let's come here. The dollar, are we going to be dividing, or we are going to be multiplying? Let's come here. Okay, we are going to be using, I don't know what we are going to be doing, but we are coming to, if you are dividing or you are subtracting, then it depends on what you are going to be using. So we can see that 1.8960 is equal to £1, isn't it? Okay.
Yes, sir.
So let's assume that then 1.41 will be equal to what? We can see that we are dividing, isn't it?
Yes.
Okay. We are dividing, isn't it?
Yes, sir.
Okay. If we are dividing, the bank will be buying the dollar and be giving them pounds, isn't it?
Yes, sir.
So the bank will buy at what? Is it going to be the lowest rate or the highest rate?
The lowest rate.
No. We are dividing. If you divide with the lowest rate, you are going to be getting the highest amount. If you divide with the highest rate, you are going to be getting the lowest amount. So the bank will always buy to make profit. So the bank will buy at the highest rate and sell at the lowest rate, because we are dividing. If you are multiplying, that is why the bank will be buying at the lowest rate and be selling at the highest rate. Okay, so the bank will now buy at the current spot of what? 1.8970. So the bank will buy at that one. So we come to this one and have the USD 1346153.85 divided by the 1.8970. What are we getting?
Question, sir.
Yes, please.
You said my question is with the current spot rate. So that's 1.8960 to 1.8970. Between these two, we know that the bank will buy at a lower rate. Or
No, it depends on how you are calculating your foreign currency. If it should be Ghana cedi to USD, it means that a Ghana cedi, before you get a Ghana cedi, you always multiply. So the bank will buy at the lowest rate and sell to you at the highest rate. So that if you are multiplying, the highest will give you the highest figure.
Yes.
The lowest one. But if you count to division, the bank is not there to make a loss. No, the bank is there to make a gain. So if your bank is buying at the lowest rate, you say the bank will be paying the highest amount. And if the bank is selling at the lowest rate, if you are selling, you're supposed to make a gain. So if the bank is selling, the bank is now selling at the highest rate, the bank is going to be making a loss. So the bank cannot pay down what they are receiving. No. So if you are dividing, the bank will always buy at the highest rate and sell at the lowest rate. We have done this so many times that if you are multiplying, then the bank will sell at the highest rate and buy at the lowest rate.
Okay, thank you.
I hope you're okay now.
Yes, sir.
Okay.
Sir, please, I'm not okay. I have a question.
This is revision class, not not class to teach. So you have to be okay before you come because we are just coming to revise some things with you. But you can actually ask your question.
Okay, sir. So please about the PV receipt. Since I thought since we're dividing the rates by 2, that's the semi-annual, we are going to multiply, like it's going to be to the power raised to the power 2.
Raised to the power 2. Are you doing this for a year or just a 6 months?
The 6 months.
So what do you exponent to? If you exponent to, it means that you are going to be receiving this amount 2 times. That is, you are doing for a year because we have 2 6 months in a year. But this one we are doing for 6 months, so the compounding will be done only once, not 2. But if you are doing
Okay.
2, it means that you are going to be doing this 2 times. That is not a year.
Thank you, sir.
I hope you're okay now.
Yes, please.
Okay. Charles, what are you getting as a pounds, the equivalent of the pounds? Charles, what are you getting?
09662.
Mention it again.
709
709 66
2 622.03
Okay, 709
22
Okay,
Point.
03.
okay. So this is the pounds. Assuming you want to sell this to the bank now, this is the amount that you are going to be receiving. But is the bank going to be giving you this amount now?
It's 0.4.
Sir, it's 0.448.
0.48.
Yes.
Okay. Okay. Would the bank be giving you this amount now?
Yes, sir, they will.
Really?
For us to make an investment with. So we don't actually take it and squander it. They actually put it in a deposit account for us, a fixed
That's what
deposit.
So saying that they will give it to you, I'm saying that they will give you cash now that go to the house with this cash. That's what I mean by
Oh, no,
will they
no,
give you
sir.
this amount? No, they will hold on to this amount till you bring the what? The 1.4 before they can also release this one. So what you do is that you cannot say that you are going to be keeping this amount. So you also have to, since you are going to pay the bank in 6 months time, you also ask the bank to deposit this amount for you in 6 months time. So in 6 months time, what will be the amount that you are coming to receive from the bank? So in 6 months, these pounds will now be invested for you, and you come over there and receive the amount, the deposit. The deposit will now be, so the pounds of 709622.48 will be invested at the rate of what?
3%.
That will be 3%. So that is annual. So that will be 1.5%, isn't it? 6 months will be 1.5%. Is that correct?
Yes, sir.
Okay, so let's calculate the interest over here. So 0.03 divided by 2. I hope that is fine.
Yes, sir.
Okay, what are you having?
I'm having 10644.34.
10644.34.
0.34.
So your total amount will now be what?
This one plus the deposited money.
So you have 709622.48 plus 10644.34. Okay, the total amount, what are you getting? Then we now find it to the nearest thousand.
720 266.82.
So 7
20
20
266.82.
266.
Yes, sir.
So the 266 represent 1,000, isn't it?
Yes, sir.
Okay. So 266. Can we 266? Okay. 966 and 266. Which of them will be round to 1,000? Is that this one, isn't it?
Nice.
Okay. So it means that this
Yes.
one is less than 5 something. So we just add 00 to this one. I hope that is fine.
Yes, sir.
Okay. So let's come to, you can also calculate the total amounts like this. Alternatively, you can calculate the future value of that amount. So the future value, which is the total amount, future value is the present value, 1 plus r exponent n. Your present value is a 709622.48. Then you have your 1 plus 0.03 divided by 2. You are doing this for only 6 months, so 1. You'll be getting the same answer closer to that one. That is fine. Okay. Please, the money market is somehow complicated and confusing, so, but you just have to take your time and see what you have to do. Okay. Let's come to calculate to the nearest what the sterling receipt for the entity if they invoice in dollars and use a forward what exchange contract. So if they are using a forward exchange contract, what will be the rate that the bank will be buying this at the end of what of the 6 months? If they are using forward contracts, the bank will buy at what?
1.8860.
Okay, so if they are using forward, if they are using forward contracts, okay, if they are using forward contracts, the amount in 6 month time will be this one. So the amount in 6 month time will be this. So let's come here. The amount in 6 month time will be, so that the bank will now buy, they will sell to the bank at the forward what rate, 6 month forward rate. Okay, and the bank will buy at the highest rate, so this one. So we have the 1.8860, 1.8860. So we now come there and have the USD, which is 1.4 million divided by 1.8890, isn't it?
60.
60.
Uh,
Okay. So 1.8860. What are they having?
742
74.
742311.77.
So to the nearest 1,000 of it, 740,000.
742,000.
Yes, sir.
Yeah.
Yes, sir.
Okay. So that is the forward contract is very simple. You just get your forward rate and just convert it. So you have entered into agreement with the bank to what? To bring the 1.4, and they say they will give you $1. They'll give you £1 at what? 1.88 what? $60. So that is we have agreed on that particular rate already. So that is the amount that you are going to be what? You are going to be bringing. Okay.
Yeah, sorry. They said to the nearest pound. So it means that it will not be 1,000.
Okay. So to the nearest
It will be
pound, that will be
742,312.
so 743.
742,312.
Okay. 742,312 like this.
Yes.
Okay. 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 So let's come here. Let's come here. They say if the exchange rate were to move towards 1.8870 minus what? 1.8900 is equal to £1 in 6 months time. What will be the exchange gain or loss compared to today if the company did not hedge the transaction? Charles, how do you go about this question?
So we actually take the 1.4 million and try to convert using this exchange rate.
Okay, they say we should, how do you calculate the gain? They say you should do, if this particular one is not what, is not hedged, if there's no hedging. Sometimes the question can ask you if the exchange rate will be this one, calculate the gain of using forward rate or this one. Okay, but this one, they are saying that the hedging was not done at all. The hedging was not done at all. So what would be the exchange rate loss or gain? What it means is that you bought something from a supplier in US. The exchange rate is now what? 2 cedis to $1. You are going to pay in 3 months' time. At the time that you are paying, the exchange rate is now 3 cedis to $1. So what is the loss? The loss is 1 cedi per dollar. That's what they are looking for. Okay. So what we do over here is, if there's no hedging, sometimes a question can ask you to calculate it from the perspective of the forward contract. So they will ask you if the exchange rate has moved to this one, calculate the gain of what or loss by using what? By using the forward contract. So you can just compare the forward contract to the amount that should have been received in what? In the 6 month time. But this one we are not hedging at all. We are not doing any of the hedges at all. So we come to the C over here. Okay. What is the today's value? What is the amount in today's term? Okay. What will be the pounds in today's term?
So we have to divide the
709.
by
Okay.
1.89
Divided
by 1.8900.
no 1.8970. Okay. So
Okay, okay.
you should have been receiving this amount in today's term, 1.8970. What are you having?
We have 738,007.38.
738,007.
7
point what?
0.38.
Okay. So in 6 months' time, if the hedging is not done, in 6 months' time, okay, amount in 6 months' time, if the hedging is not done, okay, what will be the what? What will be the amount now? This will be the USD, which is 1.4. We have this figure divided by the rate now, the rate given to us in the question.
So
That will be
1.800.
okay, 1.8900. So 1.8900. How much are you getting?
740. 740.74.
So 740. 740.
Another 740.
Point what?
0.74.
Okay. So let's
74.
look at 7.4. Let's look at gain or loss. Is it going to be a gain or loss?
Again,
Okay, a gain of how much?
Of 2733.36.
Okay. 73800.38. So gain of what?
2733.36.
0.36. Okay, so this is what they are asking you. If you are not hedging the what? The exposure, okay, what would have been the amount? It's just like how we do it under the IS-21. So this is the amount that is supposed to pay today. This is the amount that you are paying. Exchange rate gain or loss of how much? Sometimes the question can ask you to calculate the gain in relation to the forward contract. So the question can say, assuming you are not using the forward contract and the exchange rate has moved to this one, what will be the gain or loss? So you compare the amount that you are going to be receiving using the forward contract in the 6 months time and the amount that you are going to be receiving if you are not using the forward contract in the 6 months time. Then you now calculate. But this one, they are asking you if the hedging is not done. It means that you are not hedging at all. You are just leaving the amount like that and see whatever want to happen should happen. Okay, whatever want to happen should happen. That is about this particular one. Okay. let's try this one. Just let's try the question number 2.
Our background is making noise.
Okay. So question number 2. Question number 2. Healthy Beverages Limited is a food processing company based in Accra, Ghana. It has imported raw soybeans from farmers in the US for processing into soy milk. The shipment is invoiced at $800,000 and the company is expected to make payments in 3 months' time. The exchange rate between the Ghanaian cedi and the US dollar is currently quoted at 5.8555 Ghana cedis to $1 bid and 5.8585 Ghana cedis to $1 ask offer. Considering that the Ghanaian cedi has been depreciating against the US dollar in recent times, the managers of the company are worried that the exchange rate might rise further over the next 3 months. The finance manager is considering two strategies for hedging the company's foreign exchange risk exposures: a forward market hedge and a money market hedge. Below are the pieces of information from the forward foreign exchange market and money markets. So we have forward market FX rates, a 3-month forward rate, bid rate, and then their ask rate over there in Ghana cedis per US dollar. And then we also have the 6 months forward bid and then ask rates. Then the money market average interest rates, we have in the Ghana money market, lending
Charles, are you there? Charles, are you there?
Let me continue.
Okay.
Money market average interest rates, Ghana money market lending and investing rate, that is 16.5%, borrowing rate 18.5%. US money market and lending, that's lending and investing rate 6.5%, borrowing rate 8.5%. Required. Suppose the risk exposure is to be hedged using a forward foreign exchange contract. Calculate and comment on the outcome of the forward market hedge. B. Suppose the risk exposure is to be hedged using money market transactions. Calculate and comment on the outcome of the money market hedge.
Okay. Okay. All right. Thank you. So this one is going to be a payment, isn't it?
Yes, sir.
Okay. So this one, the people are going to be paying. How much are they paying, and in how many months?
They are paying $800,000.
In 3 months'
800,000
time.
In 3 months' time, isn't it? Yeah.
Repeat our question.
Yeah.
Hello?
Yeah, I think I can hear you. Please, you can talk.
Please, the gain and loss.
Yes, please.
The gain or loss.
The gain and loss. Okay.
Please, the first question. No.
Okay.
He said if you calculate the gain or loss of the exchange rate.
Okay.
Please, can you hear me?
I'm with you.
Okay. Please, he said if you calculate the gain or loss for the exchange rate, the forward rate we calculated. Please, can you go over more for me? Yes.
Yeah. Sina, can you hear me?
Please, I can hear you.
Okay, you
Please,
are
the
saying
first
that,
question we calculated.
yes, please.
Please, I was saying the gain or loss that you explained now.
That the gain, the one that I've calculated, or the one that I'm asking, if they are asking to do it in comparative with the forward rate.
No, not this one. The previous one.
No, it's this one that I've calculated. If the exchange rate were to move to 1.88 and this one in 6 months time, what would be the gain? What would be the exchange gain or loss compared to today if the company did not hedge the transaction? This one you're talking about.
Oh, okay.
So this one they are not
I
hedging.
thought the gain or loss.
No, this is not to any of the hedging techniques. This one is if you are not hedging, if you are buying in USD now and you just leave the amount like that, what would be the gain if you are paying? Assuming you're supposed to pay 2 cedis to $1 today, and you are not doing anything about it. In the 3 month time or 6 month time, you are now paying 3 cedis to $1. It means that you are losing the 1 cedi to $1. So that's what they are doing. So they are not hedging at all. So what is the today's amount that they should receive at the spot rate? Then we compare that amount to the future exchange rate and see the movement over there. So the movement is just a gain or the loss. That's what they're asking us. So I was trying to explain, maybe sometimes they can also ask you to calculate the gain in relation to forward contracts. So you just compare the forward contract amount in 6 month time to the amount that you should have received in 6 month time if you are not using the forward contracts that you compare to get your gain. Okay. So that was what I was saying. All right. Let's come to
Okay, thank you.
all right now. So these people, they are paying what? They are paying $800,000 in what? In 3 months time, isn't it? Okay. So they are thinking about hedging using forward contract or what? Money market, isn't it? Okay. So if they are using, please, this is a Ghanaian company. They are going to be using Ghana cedis to what? To pay. So what they are asking you to calculate is that calculate the CD equivalent of this amount in 3 months time. So they are going to be paying what? They are going to be paying $800,000 in 3 months time. Okay. And they are saying that if they are using the forward contract now, what is the forward contract? What are the rates? What are the 3 months forward contract rate over here? We have 5.8755, which is the rate at which the bank will be buying the what? The dollar. And we have the offer rate or the ask rate, which is the rate at which the bank will be selling. So the bank will now be the one selling to what? The bank will be the one selling the dollar to what? To the company now. At which of these rates? Well, the bank will sell at which of these rates? The 3 months. Which of the rates?
5.87.
8.85.
Okay, the bank will always sell at the highest. This one we are multiplying. This is a Ghana series. We are multiplying. So the bank will sell to them at the highest rate. So the 3 months forward. So we come to question number 2 there, which is the what is the name of the company? Okay, Saudi Beverages. Okay, so this is what we do. So using the forward contract, which is the A, using the forward contract, okay, the amount will be what? 800,000 multiplied by 5.885.
785.
Okay. Okay. So USD. So the USD will cancel. How much are we getting in Ghana cedis?
4702800.
470.
2800.
Okay, so you say calculate and comment on your answer. Okay, calculate and comment on your answer. Okay, calculate and comment on the outcome of the forward market hedge. What are you going to be saying?
So you just tell them the amount that you are paying in 3 months and using the forward foreign exchange contract.
Okay, that's not bad. Do you have anyone else with a different side? Yeah.
And what if you use the spot rate and then you convert the dollars into CD as a spot rate, and before using the forward contract, and then you compare and you look at
the additional amount that they have to pay.
Yes, please. And then you write a comment on that.
Yeah, that is what you're supposed to do. Okay. Okay, so they will be paying this amount now, but they will be paying if they should settle the transaction at the transaction date, how much should have been paid. So you calculate the spot rate, then you compare and say that okay, they will be paying this amount at the settlement day as compared to this amount. It means that they are paying excess of this amount they are paying excess of this amount to be able to settle this particular USD. Or you can just look at the difference over here. If they should settle on the spot at the date of the transaction, this would have been this one. Okay. This would have been what? It would have been 5.855. So what is the difference here?
$16,000.
Although you can just look at the rate, just the difference between them, not the total amount. $5.8785 minus 5.8585. What is the difference? Zero point what?
02.
Okay, 0.02. So at the settlement date, the company will now be paying or will now be spending or will now be what? Spending additional amount of 0.02 Ghana cedis per dollar to be able to settle the transaction as compared to the one at the what? At the spot rate, which is the same as you multiplying this by the 800,000. Okay. So you just compare. Okay. You just compare the amount that they should have paid at the spot rate and the amount that they are paying now. What is the difference there? So you talk about the difference, the excess amount that they are now paying to what? To settle the 800,000. That is the comment that they are talking about. If they should settle the transaction today, how much would that be? And they are now settling in 3 months time. So what is the excess amount that they are paying to settle this particular amount? Okay. That is a comment that they are talking about over there. So we have that one. Now let's go to money market now. So money market, this is payment. Mostly the money market, the question that will come to you will always be for payments. And that is somehow some way. Just how do we go about the issue of the payment when we are doing money market?
Hello?
Yeah, we are together.
Okay. So with the payment in the money market, we look at the present value of the amount you are expected to pay in the future, but we discount it using the deposit rates of that amount. And then when we do that, we convert it and then multiply it by the interest rate for that duration. And then at the end of the day, we actually make the payment.
Okay. All right. So this is what we do for the payments. Okay. The payments, what will happen is that the entity will now go to the bank. Okay. The entity will now go to the bank now. So we are paying. So we are now going to the bank to buy. Okay. First we are receiving. So we will now sell to the bank. So we will now go there and borrow. Okay. We will now go and borrow the foreign currency in our home currency. So what it means is that we are going to be receiving. So we borrow the equivalent of that currency now and change it to our home currency. But what is going to happen now is that we are also going to the bank now to buy. We are going to be using our home currency to buy the foreign currency and now put the foreign currency on deposit for some time before we now make the settlement. So the two is the same, but the way we go about it is different. Okay, what we are going to be doing is that the receipts, we are going to be borrowing the foreign currency in the foreign currency and convert it to what? To our local currency. Okay, if you count to the payments we are also going to be borrowing. But the borrowing that we are going to be doing, we are going to be using our local currency to what? To pay for the amount that we are going to be borrowing. So if we now use the local currency to borrow or to buy the foreign currency, we now put the foreign currency on what? On deposits for some time, because the money market, the time that we are doing this particular transaction is not the settlement date, but we just want to act fast so that the exchange rate will not affect us. So we are going to be paying 800,000 in 3 months time. So this is what we will do. Okay, this is what we do. We don't want to wait till 3 months time, then we go to the bank and buy this amount. No. We want to have an arrangement with the bank now that, okay, we are going to be paying this amount in 3 times. Okay, we want you, the bank, to borrow what? To borrow an amount to us now in what? In USD. We borrow an amount to us in USD so that if we put it on deposit, it will give us at 800,000 in what? In the 3 month time so that we can settle. Or we want to buy a certain amount from you now in USD and put it on deposit. We want to buy a certain amount of money in USD and put it on deposit. If we put it on deposit for 3 months, it will give us the 800,000 in what? In USD. So what will give us that amount? What will give us that amount? What is that amount that we are going to be buying from you now? What is that amount that we are going to be borrowing from you now by paying you what? Ghana cedis. What is that amount that we are going to be borrowing from you in Ghana cedis? What is that amount? What is the US amount that we are going to be borrowing from you now? So that if we put it on deposit for 3 months, it will give us the total amount that we are going to be paying. So this is what we do. We know that the total amount in 3 month time, the total amount in three month time will give us 800,000. But we want to put a certain amount of money on deposit now, so that amount plus the interest, in 3 months time will be giving us the 800,000 as the what? As the USD. So if you are investing now, okay, if you are investing USD, what is the what? What is the interest rate?
6.5%.
Okay, 6.5%. So it means that we are looking for a certain amount of money. We are looking for a certain amount of money so that if we are able to find 3 months interest of that particular amount again, it will give us the 800,000. This is what we are going to be doing. So we go to the bank now and buy a certain amount of money in USD, put it on deposit for 3 months so that we can get the 800,000 and what? And pay. We are not doing this at the end of the 3 months. We are doing this at the time that the transaction happened, so that we can be able to get the value, so that we can be able to try to what? Try to reduce the exposure of the currency risk within that 3 months. So we are doing this now. So we go to the bank and buy a certain amount of USD and put it on deposit, USD deposit for 3 months, so that we can get a full amount of 800,000 and pay. Okay. But the question is, what is the CD that we are going to be using to buy that particular amount of dollar that we can put on deposit now for 3 months, and it will give us what? 800,000. We first of all find the amount that the dollar amount that we are going to be what? We are going to be putting on the deposit. So what we do over here is that we will still find the present value of this amount, but this one we are going to be investing. We are going to be investing in dollar because we are going to be paid. Okay. It's not we are going to be what? We are going to be receiving. The receiving is the bank will now lend that particular amount to us. Then we will now convert it to US, to Ghana cedis and invest. But now the bank will lend the what? The USD to us. We will now put it on deposit. And at the end of the 3 months, we will now take it and pay. So what amount will the bank be giving to us now, so that if we deposit it at the end of the 3 months, will give us the 800,000, so we can take and pay the people. So for this particular one, we find the exchange rate, we find the present value, but we use the what? The depositing rate over here. If you are the one going to be paying in the foreign currency, you find the present value by using the deposit rate of what? Of the foreign currency. But if you are the one going to be receiving, it means that you will now sell to the bank and receive the money in the local currency. So the bank will borrow to you in the what? In the foreign currency, and you will now convert it to local currency and invest. So we use the borrowing rate if you are the one going to receive it. So what we do over here is you just come here and find the present value of that amount that you are going to be putting on deposit. And that will give you the USD, which is 800,000, okay, divided by the 1 plus 0.065 divided by 4, because this is 3 months. So that 3 months will be quarter. So we are looking for the quarterly rate. So our present value of the amount that we are going to be depositing in USD will give us what?
Seven eight seven 207.87.
Okay, 787
207.87.
207.87.
87.
Okay. So this is the amount that the bank will now be what? Selling to us in Ghana cedis. So we are going to be using Ghana cedis to buy this. So this is the amount that you have to buy from the bank now and put it on a dollar deposit. And at the end of the 3 months, it will give you your 800,000. So we are going to be paying, we have to now buy this amount in what? In Ghana cedis. So what is the CD equivalent that we have to pay for this amount? So you count to the CD equivalent of this amount now. This will be done at the spot rate because we are doing this at the transaction date. So 207.87. What will be the CD equivalent here? At what rate are we going to be doing this now? The spot rate. The bank is the one selling to us. So what will be the spot rate there? 5.8585. Is that correct? Is a 5.8585 correct?
Yes, sir.
Okay, what are you getting?
1 moment, sir. 4611
4611
yes 857.31.
857.31. Okay,
Yes.
this is the amount that is supposed to pay the bank now, but you're not going to pay this amount. You pay all this amount. Every transaction will happen at the end of the 3 months. So it means that the bank will charge you what? Interest on this borrowing. So you are borrowing now. This is the CD that you have to what? You have to use to what? To get the dollar. So the bank will now give you this amount in CDs now, and the bank will charge you interest for 3 months. So the amount over there, you just have your CD amount over there, which is 4611 4611,857.31. So what is the borrowing rate in cedis? What is the borrowing rate in cedis?
18.5.
So
18.5.
18.5. So you now have the bank will now charge you interest of 18.75. So we have the 18.5 divided by 4. So what is the amount that you're having?
$5465050.91.
Okay. So 54
65050.91.
050.91. So this is the amount that you are going to be paying the bank at the end of the 3 months. Okay. So if you are making payment, it's somehow complicated, but it's the same as the old one. But what we do over here is we use the investing rate, because you go to the bank, buy that particular amount, and put it on deposit. So you go to the bank now, you are going to be paying. So you go to the bank now and buy. You buy now. Okay, you buy now and put, because you are going to be making the payment in 3 months' time. So you buy now and put that amount on deposit. So the perspective of calculating the CD that you have to use to pay that, to buy that particular amount now is, okay, how much are you going to be putting into the deposit today, so that at the end of the 3 months you get 800,000. So it means that you are going to be investing a certain amount at a rate of 6.5, and at the end of the 3 months it will give you 800,000. So what is that amount that you have to put over there that will attract interest of 6.5 for 3 months, and it will give you the 800,000? So we find that amount. So this is the amount that you are going to be borrowing from the bank now using Ghana cedis. So you are going to be using Ghana cedis to buy this amount from the bank. And it's this amount that you put on deposit for 3 months, you get 800,000. So if you are using CD to buy, what will be the CD that you are going to be paying for this amount as of today? This is a transaction date. So you translate this using the spot rate. Then you find your CD. But you are not going to be giving the CD to the bank now. You are going to be bringing the CD in 3 months' time. So it means that the bank will now use the CD to buy the dollar for you. So the bank is now lending to you in CDs. So if the bank is lending to you in CDs now, they will charge interest in lending for CDs for 3 months. And you will now come and pay that amount. That's why we have increased this amount by the So the bank will charge interest. This they are borrowing to you in CDs.
Yeah.
Yes, please.
The answer is 482 5155.71.
482
5155.71.
55
.71.
482 55
482 5155
okay 5155
5571.
okay. So the money market is something complicated, but just try your best to absorb it some way. We move on. So I'm saying that mostly the theory question is always about the difference between forward contract. That's why I've added that one. There are 10 here. You can actually keep 3 or 4 or 5 in your head. So you can read on the following ones too. Okay, let's do some things on the time value of money. Like let's do some 2 issues on time value of money. Then we now see that is it. Okay, question number 1.
Question number 1.
Yeah.
Veronica is planning her daughter's 6-year medical school education, which begins 10 years from now. Teresa estimates the yearly tuition, textbook, and living allowances to be 15,000 Ghana cedis to be withdrawn at the beginning of every semester of the year. She is a board member of Nkontompo Rural Banks and intends to borrow the money from the bank now at a concessionary interest of 9% so that she can invest it in an account that pays annual interest of 18%, from which she will finance her daughter's education. So required. A. How much must she borrow from the bank for the intended investment? And B. Set out an amortization table for the repayment of the loan if she intends to take it for 5 years.
Okay. All right. Okay. So let's come here. It's a very simple exercise. Okay. But you have to be very, very thoughtful to be able to address the issue. Okay. So they are saying that the Veronica is planning her daughter's what 6 year medical school education, which begins 10 years from now. So that means in all that will be 16 years. She's planning this from now. Okay. So the Teresa estimates that, or it should be Veronica. So Veronica estimates that the yearly tuition, textbooks, and living allowances to be 15,000 to be withdrawn at the beginning of every year, every semester or the year. She's a board member of the rural banks and intends to borrow the money from the bank now. Now means what? Now, isn't it? Which is 10 years from what? From the start of what? Of the child's what? Education, isn't it? Okay. So first, the one that I solved, it was not now. So I've decided to add a now so that I can demonstrate something for you, because I don't want to solve the second question. So that's why I've added a now, so that the two questions, the first two will be the same thing. Okay. So from the bank now at a concessionary interest of 9%, so that she can invest in it in an account that pays what? Annual interest rate of 18%, from which she will finance the daughter's what? Education. How much must she borrow from the bank for the intended investment? Set out an amortization table for repayment of the loan if she intends to take it for 5 years. Charles, what do you think about this question? How do you think we should go about it?
Okay, so since the whole idea is to know how much she's going to borrow in the first place before this whole investment happens, we have to know the future value of we have to know the present value of the investment. And that present value of the investment is going to be the future value of the loan amount she's going to take. So we've been given 15,000 Ghana cedis to be withdrawn at the beginning of every month. So it means that there's an annuity factor here. So what we have to do is look at the annuity due. The annuity due is 15,000 at the beginning of each year. So we have to look at the present value of annuity due. And that present value we get is going to be the future value of the amount she deposits, the future value of the loan amount she deposits. So we just present value that one too, and becomes the loan amount she took.
Hey, my guy. Yes, yeah, you're doing well. You're doing well. You're doing well. That is fine. Okay. So okay, let's come here. That is fine. That is all about it. Okay. Okay. So this 15,000, they will start withdrawing this particular 15,000 from when? The 15,000, they will start withdrawing the 15,000 from the account when when the person starts the education, isn't it?
Yes, sir.
Okay. And this withdrawal will be for how many years? 6 years, isn't it?
Yes, sir.
Okay. So this withdrawal will start from the time that the person will start schooling. So this withdrawal will be done for 6 years. Okay. So we want to know what will be the amount that will be in the account at that time before the person will start withdrawing what? Withdrawing 15,000 at the beginning of every year to the end of the 6 years. The school will start in 10 years' time. It will begin 10 years from now. So it means that the withdrawal will start from the 11th year. So we want to know how much will be in the account before the person will start what? The person will start what? Withdrawing 15,000 every month. What it means is that you are putting a certain amount of money. You are putting a certain amount of money. Okay. Or what is the amount of money that you have to what? Or what is the amount of money that you have to put in a bank that can be giving you a cash flow of what? 15,000 at the beginning of every year. That is the idea about it. So this one we use present value, but the present value is going to be for 6 years. So what we do over here is that, okay, what is the what? I'm going to be getting a certain amount of money, or I'm going to be putting an amount in an investment, and that particular amount or that particular investment will be giving me 15,000 every year at what? At an interest rate of what? 18%. So I want to put a certain amount of money in the investment now. And this investment will be giving me interest at 18%. And this will now allow me to what? To withdraw 15,000 at the beginning of every year. How much should I put there? So it means that the amount that will be in the account will be any interest of what? 18%. So let's come here and deal with that particular one now. So the starting point is this one. So we have question number 1, which will be time value of money. Okay. So question number 1. So we have, the question is about Veronica. So we'll be looking at time value of money. Okay. So what amount do you have to put in account today? And this amount will allow you to be what? To be withdrawing 15,000 at the beginning of every year. So you just find the present value of the cash flows. So this one is done at the beginning of every year. That's an annuity due. So we count to the present value of annuity due. We'll be having the amount into bracket 1 plus R. Is that correct? 1 plus
Yes.
R multiplied by 1 minus what? 1 plus R exponent negative n, okay, divided by R, isn't it?
Yes, sir.
Okay. So we don't know our present value, okay, but we know the amount that we are going to be getting. So it's just like, what amount do you have to invest today at 18%? That will enable you to be getting what? 15,000 at the beginning of every year. This is our annuity due. Okay. So what we'll do over here is this one. So our amount will be 15,000 over here, 1 plus 0.18. Okay. The amount that we are talking about, it will be in account, which will be any interest, not the borrowing rate. No. The interest will not be paid on the investment using the borrowing rate. No. The interest will be paid on the amount that we are borrowing using the what? The investment rate, which is the 18%. So the amount that we are putting over there will be any interest of 18%. So how much should be put there? So what we do over here is we multiply this by 1 minus 1.18 exponent negative 6 divided by 0.18. What are we getting?
The annuity factor is 6.296.
6 points.
296.
Okay. I'm getting 17,700 for this one. Okay, 6 points what?
296.
Okay, so if you multiply, what are we getting?
Hello.
Yes, please.
It's 3.498.
Yeah,
Three.
I'm having 3.498 for the annuity factor.
498.
3 points.
Yeah.
498.
498.
Okay. What are we having as a total amount?
$61,914.6.
Okay. This amount will be, this is the amount that will be in the account. This will be the amount that will be in the account before the what? The child will start withdrawing, isn't it? Okay.
Yes, sir.
But this amount will be in the account at the end of the what? the 10th year, isn't it? These amounts will be in the account at the end of what? Okay. This amount will be in the account at the end of the 10th year. Okay. Because this 15,000, they will start withdrawing the 15,000 from the time that she started the school. But the school will begin from 10 years from now. And we are thinking of borrowing the amount from the bank now. So the amount that we are going to be borrowing from the bank, if we invest it for 18%, the amount that will be in the account before my daughter will start withdrawing is what? 61,914.4. When would that particular amount be there? It will be there when she started what? Schooling. But the schooling will start 10 years from now. So that is the amount at the end of what? Of the 10 years. So if that is the amount I will have in the account, if
So we have
that is the amount that you have at the end of the 10 years, okay, it means that the amount that we are borrowing now, this is the amount that will be there at the end of the 10th years because we are borrowing now. This is the amount that will be in the account before my daughter will start withdrawing. When will she start withdrawing? She will start withdrawing at the time that she started school, which is a 10 years from now. 10 years from now. So it means that this is the amount that will be there at the end of the 10 years. Then she will start withdrawing at the beginning of the 11th year. Okay. So this is the amount that she will be having in the account. So it means that the amount that I'm borrowing now, I have to invest that amount for 10 years. So I invested a certain amount of money for 10 years, and this is now I'm having this one. So what will be that amount I have to invest at the beginning of the year? So that I'll have this amount in the account at the end of the 10 years. So this is now becomes the future value for the amount that you have borrowed. So you have a certain amount that has been borrowed from the bank now. You have invested it for 18%, and you are now having this amount at the end of the 10 years. So how do you calculate the amount? This is how you, so that this is the future value now. So the amount borrowed now. So the amount borrowed now will be the future value of that one divided by 1 plus R S N. Okay. So we have the amount to be 61,914.6 divided by 1 plus 0.18 exponent 10. So we have the amount to be what? 61,914.6 divided by 1.18 exponent 10. What are we having?
One 829.68. 829.68.
829.26.
68.
Okay, 68. So this is the amount that we are going to borrow now. So this is the amount that you borrow. You invest it for 10 years. Then your sister, your child will start withdrawing 15,000 from it. So we are first of all, the starting point is that you have to look at the amount that will be in the account before your daughter will be withdrawing the 15,000. That is the amount. But this amount will be available at the end of the 10th year because you want to start investing now. So this will be available at the end of the 10 years. So how much do you have to start investing now before at the end of the 10 years when she starts schooling, this amount will be there. So this is the future value for the amount that you have to invest today. So you find that particular amount. The amount will also be invested at the 18%. So you find the present value of that amount. And this is the amount that you'll be borrowing from the From the bank. This is the amount that you borrow from the bank. A very simple one. So the amount borrowed is what? 11,829.68. Okay. Now the B part is the bank is now asking you to set an amortization table for the repayment of the loan if she intends to take it for 5 years. So this is the amount that you are borrowing now. Okay, if you intend to take this amount for 5 years, how much are you going to be paying every year? So just like, okay, how much are you going to be putting into an account? Okay, how much are you going to be receiving? How much you are putting a certain amount of money in an account at the end of every year. So we don't know how she'll be what she'll be paying the amount. Okay, so we don't know how she will be paying this one, but if nothing has been said, then you assume that she is paying what? She's paying at the end of every year. So she'll be paying the loan at the end of every year. Sometimes you can say the loan will be paid every quarter. Okay, so how much are you going to be putting? How much will you put into account so that at the end of every year, if you present value all those cash flows, you'll be having this figure. So this is loan. Loan for you to find the amount. So we want to know the equal amount that we are going to be paying every year. So we come to the equal amount to be paid at the end of every year. So you'll be paying the loan at the end of every year for 5 years. So the present value is now 11829.68. So how much will you be putting there? How much will you be putting there at the end of every year? And the present value will give you what? 8 point this one. So we now use the present value to find the amount. So we come to the B part. Before you draw the loan amortization table, you have to know the amount that the person will be paying at the end of every year. So how do we calculate that? We look at the present value is equal to amount multiplied by the annuity factor 1 plus R exponent negative n all divided by R. So this is loan. We have the present value and we are looking for the amount. So how much should we put into an account at the end of every year? That will give us what? The present value of this. So we find the amount over here by using the annuity factor. Okay, exponent negative n all divided by the R. Okay, so we have the present value over here. We have the present value to be 11829.68. Okay, so this one we use the interest rate of the loan. So we are borrowing at 9%. So we'll be paying the amount at what? 9%. So how much will you be paying, or how much will you be putting into an account at 9%? At the end of the day, you have this particular amount. So you have the A multiplied by 1 minus into bracket 1.09 exponent negative 5, because we are doing this for 5 years, divided by 0.09. Okay, the annuity factor is what?
3.890.
890. So what do we do? How do we find the A? We divide through
We
by what?
divide 3.90.
Okay, 3.890. So what are we getting as an A?
3041.
30.05.
3041.05.
So you now come to your amortization table now. The loan amortization table. Okay, this one I will not do it in full. Okay, I will just do some parts and leave the rest for you. So we have the years over
Yeah.
here. We have the balance at the start. Okay, we have the interest because we are paying at the end of the year. Then we have the payments. So we have the closing balance here. Okay, so year one, how much are we owing the bank? We are owing them 1129.68. That is the amount that we have taken from the bank, isn't it?
Yes, sir.
What will be the interest rate? We are paying the interest at 9%.
1064.67.
10.
64.
64.67.
Okay. So you have 1064.67. Assuming we are not paying any amount to the bank, the total amount that we are going to be owing them is the loan taking plus the interest, isn't it?
Yes.
But we are paying 3041.05. So how much will be left?
9853.3.
So 9853.3. Okay. So we are owing the bank 1129. We have to pay interest. So the total amount is this one. We have paid 3041. So year two, we'll be owing the bank 9853.3. Then they will charge interest. At the end of the year, we pay them this amount again. Okay, that is how we do the loan amortization. Sometimes they can ask you to show the interest payment and then the principal payment. How do we show it? Okay, so if you come to the payment over here, sometimes they can ask you to show the interest that you are paying and the principal also. So this is how you do the payment if they ask you for this one. So the interest is what? 30 is 106467. So you are paying the interest of this. The total amount that you are paying is 3041.05, isn't it? Okay. The interest payment out of this is what? You are paying this amount as interest. What will be the remaining amount? Out of the 3041, 1064.67 is relating to interest payments.
76.3.
So you have 1976.8. So that's how you split it among the interest and the principal. So at any point in time, what you do is how much are you paying? What is the interest for that year? The interest is relating to this one. So what will be the remaining amount? That will be for the principal. So the year two, you come here, you calculate the interest. Then the interest will be the payment of the interest is including the amount that you are paying. So if you take the interest from the amount, how much will be left? The amount left is for the what? Is for the principal. The amount left is for the principal. Okay. So let's see. Let's see if we can. The question number two follow the same listing like that. That's why I added the noun to this one. So this one is the noun was not there. Okay, I don't want to solve the question number two. So they're all the same thing. They follow the same
Okay, then
issue or there.
question number 3.
Yeah.
Question number 3A. JNQ has the following investment options to choose from. Option 1, Post Office MIS scheme, monthly interest of 8% per annum. Option 2, ICD bank deposit, quarterly interest of 8.25% per annum. And HDFC Limited, half yearly interest of 8.50% per annum. We are required to use effective interest rate method to advise JNQ on the preferred investment option.
Okay, so they are saying that we should use effective interest rate, isn't it?
Yes, sir.
How do we calculate effective interest rate?
So 1 plus R over M exponent M minus 1
Or multiply
by 100.
Okay. So we have actually demonstrated why we have the 1 plus R. So this one, we just have to solve the question. Okay. Okay. Just if they are telling you that you should increase, if they are telling that you should increase 20,000 by 10%, how are you going to be calculating that? It will be 1.1, isn't it?
Yes.
Okay. So you'll be doing something like 100% plus 10% of the same amount, isn't it?
Yes, sir.
Okay. Which will give you 110%, isn't it? Of the amount,
Yes.
isn't it?
Yes, sir.
Okay. So it means that what you are doing over here is you are doing 1 plus the what? The 0.1, isn't it? 100% is 1. If you divide is 1, isn't it? And this will give
Yes,
you
sir.
the amount that you're supposed to have, which is 1.1. So if this is the interest rate, you consider the 1.1 over here is included the interest and then the principal. Are you okay? The 1.1 over here is including the interest and the principal. Is that correct?
Yes, sir.
So if you want to get your interest rate now, it means that you subtract 1 from this one, and that will give you what? 0.1 as the original interest. Okay. So this interest, how do you calculate the interest? How do you calculate it? It can be quarterly, it can be yearly. So what we do is the effective interest rate is calculated from this particular. The effective interest rate is calculated from this particular what? Perspective. Okay. So this is what we do. So we just have our yearly what compounding figure. So effective interest rate is calculated as what? The 1 plus R over the M. The N is the number of times the compounding has been done. Exponent M. So if you are doing it for 1 year, this is how you are going to be increasing it. So we know that this is now this is together with the interest and the principal. So the principal is 1. So let's just take 1 from this answer. So the principal is 1. So let's take 1 from this answer and now have what? Our interest rate. So this is what we do. So let's come to the first one there. The first one, what are we having? The first option is that.
Monthly interest of 8% per annum.
So that will be MS. That will be the post office MS. So let's have the first option to be. Okay. So the effective interest rate will be 1 plus what?
Plus 8%.
0.08 divided by
monthly.
So that will be 12, isn't it?
Yes, sir.
Exponent what?
Exponent 12.
So if you want to do it for 1 year, this is how we do it. We find the yearly rate and now exponent. Okay. So this will now be -1. Then we multiply the answer by. So what are we having? 1 plus what?
Zero point 0.00667.
Just do all. 1 plus that figure, all exponent 12. What are we getting?
8.3.
8.3. So let's go to the second option.
ICD Bank quarterly interest of 8.2.
ICD. That is quarterly, isn't it?
Yes, sir.
So we have 1 plus what?
8.25%.
So 0.0825 divided by
4.
Okay, so the quarterly will give us 4. So quarterly rate will give us 4. Exponent what?
Exponent 4.
Exponent 4. So annually will give us that one -1. The answer multiplied by 100. What are you getting?
8.51.
8.51. Okay, so 8.51%. The last one is what?
HDFC Limited half yearly interest 8.5% per annum.
So effective interest rate will be equal
No wonder
to
Brian is making it.
So we have 1 plus. What is the interest rate there?
8.5%.
Okay. So 0.085 divided by
2.
okay. Exponent
2.
okay.
2.
-1. Okay, what is the answer?
8.68.
Okay, 8.68. Okay, so what would be the advice now? The advice you have to consider what they are doing. Are they investing or they are borrowing?
They are investing, so you can say the last one, which has a high interest.
Okay. So they are what? They are investing, isn't it? So if they are investing, they have to pick the highest what? Okay, and that will give us the third one, isn't it?
Mm-hmm.
But if they are borrowing, what will happen?
They'll take the lowest one,
They will pick the what?
the first one.
Okay. Okay, let me do something on the sinking fund. Okay. Sinking fund is also one of the areas. So let me do the B. Just the B.
Okay, B. Brain Limited intends to purchase new machine costing 303,000 Ghana cedis. The funds to buy the assets are being provided as a loan by the CEO of the company at an agreed rate of interest of 12% per annum. The loan and interest will be repayable in full at the end of the fourth year. To provide for the eventual repayment, the board of directors has decided to put an equal annual amount at the end of each year into a sinking fund account to earn 14% per annum. So require, what must be the annual payment into the sinking fund so that the loan will be repaid after 4 years?
Okay, thank you. So Charles, what is a sinking fund?
It's a fund set up to make constant deposits in to take off a future expense.
Okay. Okay. So before you decide on how much you'll be putting into that particular account at the end of every year, what do you have to know first?
The future expense.
Okay, you have to know the future amount that you are going to be settling. So you always have to know the sinking fund is just what? It's just like you want to at the end of what? At the end of your 10th year of service, you want to what? You want to now put in your own structure there. Before you start what? You start what? Investing towards this particular commitment. You have to know how much you are going to be spending at the end of what? Or the end of the 10th year. You have to know how much you should be spending there. Then you now decide how much you should be putting into an account every year towards this particular commitment. So for you to know the sinking fund is always for a future commitment. But before you start making any decision on how much should be put there, you have to know the amount that you are going to be what? You are going to be paying, or the expenditure you are going to be making at the future date before you can start. The sinking fund is always for what? Future value, whilst loan is always for present value. So we use present value to do loan. We use future value for the sinking fund. Okay, let's now come here. The entity intends to purchase a new machine costing what? 303,000. Okay. The funds to buy the assets are being provided as a loan by the CEO of the company at an agreed rate of 12% per annum. The loan and interest will be repayable in full at the end of the fourth year. To provide for the eventual repayment, the board of directors has decided to put in an equal amount at the end of each year into a sinking fund account to earn interest, to earn 14% what? Interest per annum. What amount are we making this provision for? It is a repayment to what? To the CEO, isn't it?
Yes, sir.
So what do we have to do? We need to know the amount that we are going to be paying the CEO at the end of the what?
4 years.
Okay. They are saying that the loan together with the interest will be paid at the end of the 4 years, isn't it?
Yes, sir.
This is a compound interest, isn't it?
Right, sir.
Yeah, this is a compound interest because we are not going to be paying the interest. So the principal together with the interest will be paid at the end of the 4 years. What it means that the principal and the interest will be rolled over at the end of every year. But if the question should tell you that the interest will be paid at the end of every year, whilst the principal will be paid at the end of the fourth year, that is a simple interest. Because at the end of every year, you are paying the interest. So there's no interest attached to the principal to earn what? To earn additional interest. So the interest will be on the principal at the end of every year. So the amount that you are going to be paying at the end of the 4th year will only be what? Will only be the principal. But if they say the principal and then what? The interest will be paid at the end of every year. It means that the interest together with the principal at the end of every year will be reinvested to earn interest. So this will be a compound interest. So we need to find the amount that we are going to be paying the CEO at the end of what? At the end of the 4th year. So how do we find that amount? We find our future value is equal to present value 1 plus R exponent n. Because at the end of every year, the amount is increasing by what? By 12%. So we have our future value. The amount that we are taking from the principal today, the CO today is 300,000. That is the present value. This is the amount that we are taking today. And it will be increasing by 12%. So we have 1 plus 0.12 exponent 4. Do you agree?
Yes, sir.
Yes.
Okay. So let's now have that particular amount now. We have the future value, okay, to be equal to 300,000, 303,000, okay, 1.12 exponent 4. The total amount is what?
476.
476.
776.
776.
0.37.
0.37. So this is the amount that we are going to be paying at the end of the 4th year. This is the amount that we are going to be saving towards now. So how much should we be putting into the account at the end of every year? So we just come to the sinking fund now. Okay, sinking fund also follow the principle of annuity because we'll be putting an equal amount into the investment at the end of every year. So how much should be put into an investment at the end of every year at an interest rate of 14%? That will give us what? 476,776.37. That's an annuity. So we use future value of annuity. So we have the future value of ordinary annuity because they say at the end of every year. So we have future value of the amount multiplied by 1 plus R exponent n minus 1 all divided by the R. Okay, the future value over here is the amount that we are paying to these people. So 6776 is equal to E multiplied by, we have 1 plus 0.14 exponent 4 minus 1 divided by 0.14. So we have 477. Okay, let me make this one well. So let me just do the A for you so that you can actually, we are looking for A. So you make the A the subject. So we have 476,776.37 divided by 1 plus, okay, let me do 1.14 exponent 4 minus 1 all divided by 0.14. So the answer that you get over there will be the amount that you'll be putting into the fund at the end of what? Every year. Very simple about sinking fund. Any issue?
No, sir.
All right. So if there are no issue, tomorrow we will do working capital and investment appraisal. Then we know that we are done. Okay. So thank you for coming. Have a nice day.